Hello, everyone. Thanks for joining us in this workshop on liquidity and fixed income markets. First, let me thank our co-organizer, Ben Laster, Pierre-Olivier Weill, and Mahyar Kargar for helping us putting this program together. Just some quick notes. These are short presentations, 20 minutes, so they're going to be uninterrupted. Please feel free to use the Q&A feature from Zoom to make your questions, and we are going to have 10 minutes after each talk to go through some of the questions. The slides are available on our website, so you can go there and download if this helps you to follow the talk. And please avoid any abusive or offensive questions during the talk. And I'll turn to Pierre-Olivier Weill to make some opening statements. Thanks. Pierre?
Unmuting myself. So, hi everyone, welcome. So first, Mahyar, Ben, and I would like to thank all the speakers for accepting the invitation and for the audience for tuning in. We're very excited about this learning opportunity. As all of you know, in the early stage of the COVID-19 crisis, financial markets have been in considerable turmoil, and fixed income market in particular have experienced considerable stress. And in response, the Fed took a number of unprecedented action, for instance, announcing and later implementing large-scale purchase of corporate bonds, so expanding QE in new territories. Financial economists jumped into action and did something we rarely do. We perform research in real time. So the objective of this conference is to recognize the hard work everyone has done in a short time period and set the stage for this research. The first step is in understanding what happened during this episode. So today we will take stock of some key empirical evidence, establish some basic facts, learn about economic mechanism at play, and discuss hopefully open questions for the empirical and theoretical research agenda going forward. So without further ado, I'm going to kick off the first session of this conference with a presentation on the Treasury market. The first presentation is by Zhiguo, who's going to become the co-host.
Thanks. So, I only have 20 minutes. Everybody can see my slide? Yeah, good.
Yep.
Okay, good. So this is about the Treasury inconvenience during the crisis, although that is a title only about the COVID-19, but we actually did some work as well on the 08. So the comparison between the recent crisis and 08 actually is quite interesting. And let me just, okay, sorry. Okay, good. So this is what everybody in this room must know, which is basically that during the worst time, March 9, March 23, we on the stock market side we had a 4 halts, which is like circuit breaker. So it's really drawing down quite a bit on the stock market. And interestingly, Treasury market goes, the yield goes up, which means that the price goes down. So it's a positive correlation or positive beta. All right, so we are asking several questions. Typically we know it's negative beta, but not this time, at least during that episode. So why was it different? So there are, different ways of thinking about it. The first one is the canary in the coal mine story, that it will no longer be the negative beta. And the second one is more or less is like priming issue, market dysfunctionality, all these things that I believe that Darrell will talk more on the even more details about. We are going to emphasize supply demand. So we do some quantity price analysis. And I want to emphasize that in the third bulletin, both are non-exclusive. It's not like we have one and not the other, right? All these things is just could be positive, interacted, and some of them requires time to resolve. So the different frequency also is there. The juries are there. Our hard evidence is more on the second, but it's worth checking that are there any deeper fundamental move around. And Arvin and I both are writing a NBR report on this issue, and we were basically also debating each other. So it's kind of interesting ways to see all these different evidence. So today I'm going to tell you a little bit of the quantity side of evidence, then provide a very simple theory, and then showing you the empirical analysis. And then last, I will put like 3 minutes or 4 minutes on the 2008 crisis in light of the way we are thinking for the 2020. All right, a bunch of, so first of all, that, we want to refute a lot of usual story, which is inflation, because we expected the balance sheet expansion, etc. No, inflation expectation going lower, inflation uncertainty also going lower. So that's not the truth. So then we look at the quantity. Okay. So first thing we look at the quantity, obviously, is the natural supplier of the long-term bond. Yes, indeed, true that using based on these quarterly, because it's basically a periodic issuance. So Treasury issuance in March is pretty high, about 150. And keep in mind that these numbers, in the end, we would like to add them up to see that whether they kind of basically check off or not. All right. So Fed Treasury is selling. This time that you can see different reports, newspaper, etc. What's mostly striking is the foreign investors are selling up quite a bit at the similar quantity or even larger quantity than the Treasury. So you see all these Asia, Caribbean. Some of them actually are hedge funds who registered in the Cayman Island and all these people, the usual suspect of doing the levered positions, etc. All right, so here is the long-term government mutual fund. They are also selling, although the quantity is slightly smaller. Okay, and then this is the primary dealer balance sheet. So we are thinking about, in the model, we are thinking about the primary dealers. They could buy themselves, but also can provide a financing for some other levered investor who didn't initially take into this position. So now they have some powder and they borrow from the primary dealers. So that's the usual way of thinking about the financial market. What we see from here is that the direct holding, so this is the net Treasury holding, direct holding, not that much, kind of small. What's really big expansion is this repo. This is a gross reverse repo. So gross reverse repo is basically providing financing to the other party who are doing repo, which is taking leverage positions in the Treasury. When Treasury goes down, it should be the good time for them to step in. Okay, all right. So all these things putting together, you see that the supply foreign holdings goes, they drop by 300 billion, which means that they're dumping 300. And then this is the 15, 150, total is 465. In the very, very short-term period, that it seems like, from our calculations, that everything is through this dealer. So dealer direct holding increases very 50, which is, it's okay number, but it's not, it's way below the total supply. But the repo financing provided by dealer is pretty big. Okay, so that's the basic factor that we will put into the model. Here is the Federal Reserve holding during that period. Later on, you will see that after the March 23, which is the basically our model is not trying to capture, but in the longer run, of course. But before the March 23, they increase a little bit, but not that much. Okay. All right. So here are the questions, and we will emphasize the balance sheet constraints of dealer banks. This is the why that we emphasize the dealer banks are doing two things: one, direct holding; the other is leverage, is providing the repo. And what we are emphasizing, you will see here, is the balance sheet constraint. This is a supplementary leverage ratio thing, and we will introduce these empirical concept and showing you how do we think about it in the model, and then later on showing you the evidence on that. One is the slope of the yield curve and the Treasury inconvenience yield measured by the Treasury yield minus the OIS thing. And OIS is these derivative contracts that are free from the balance sheet cost. And then what's more important is that the repo rate spread, which is that these dealers, they actually, during the worst time, they are able to borrow really low, lending very, very high. So which means that it just reflected that they're earning the constraint rates. All right, so just a quick time. So the model is very, it's classic, although that we did a lot of work to expand it to accommodate more stylized features that are showing up in the data. So this is taking the Greenwood Viennese. In Greenwood Viennese, they only have arbitrageurs. In our model, we decompose arbitrageurs into levered investors and the dealers. And what's more important, that the levered investor will borrow from dealers, as I emphasized. Okay, so three groups of investors. Habitat investors, they are exogenous demand and supply. And then levered investors and the dealers. We emphasize the supplementary leverage ratio. Right. Okay. Very quickly, you have an aggregated risk and habitat agents. Habitat agents are exogenous holdings, so they hit some shocks and they have to sell in the context of 2020. They include leveraged hedge funds who were heavily engaged in this treasury cash futures. There's a bunch of reports on that. I'm not getting into this. Okay, so then you have this shock. We take it as exogenous, and the shock can be specialized to this exposure, which means that it could be maturity dependent. So theta tau here is really the, whether it's a 10-year or 1 month or 3 months, etc. So here just saying that for longer side of a maturity than you're selling. All right. Okay. So we have a levered investors. Both levered investors and the dealers all have a mean variance objective. For levered investors, what they're doing is basically they're buying these treasuries, but they're financing it at a big RT. Okay, this is the gain. They financing it at the big RT. Big RT will be endogenous later. Dealers, the same thing. They have a different risk tolerance. Here is the hedge fund risk tolerance, but they are doing the same thing. The only difference is the follows: that the dealers can do the direct holdings and the reverse repo. So they provide a financing to the hedge funds. Dealers fund at RT and earn big RT. Small RT earn big RT in reverse repo, and therefore they have this repo spread. Okay, great. With these two things, we can see that their problem is basically XT. This is a direct holding, and they hold it, but minus the balance sheet cost. And here repo is also the same thing, because that they are using the balance sheet to provide the repo financing. So it turns out that whenever you either direct holding or you're lending through the balance sheet to the hedge funds, they occupy the same balance sheet size. So as a result, the balance sheet cost showed up in both. We will take the balance sheet cost function as a given. So there will be the total balance sheet is BT, so lambda T equals lambda as a function of BT. And for simplicity, we just say that if the aggregated balance sheet is big, then it's just a linear in it. And the balance sheet, total balance sheet will be determined in equilibrium, which is basically total things that they're taking. All right, so the key, obviously, and then you have a market clearing, etc. The key is that when hedge fund sector buys bonds from the dealer with a repo financing, it is risk sharing, but no relaxation of the dealer's balance sheet, right? Then it said that the risk is going to the hedge funds, but you still occupy my space. All right. So with 1 minute, I will tell you the model. How do we solve the model? And you will see that immediately. So imagine here, this is just an illustration of the how do we solve it. Beta shock to habitat agents holdings, H goes up, which means that you're selling. Okay. In the end, in the model, you're either absorbed by direct holding of the dealer or absorbed by the hedge fund, their holding, but via repo. Whatever it is, it's always sitting on the balance sheet of the dealer. This is why dealer's balance sheet B will be exactly equals to the H, which is exogenous given. Okay. Now, then the question is that, okay, fine, that these two things are always there. Therefore, they will charge the cost, the rental cost, you can imagine that from the hedge fund to compensate the balance sheet cost. So the equilibrium repo spread will be immediately get it. Now, how do we solve the equilibrium treasury curve? the space can be rented, but it's really the risk sharing. How do we think about it? It's almost the same idea, because these dealers and the hedge funds, they have a slightly different risk tolerance, but then in equilibrium, they just optimally risk share each other. All right, because the rental cost is just exactly the same. Therefore, we can solve the Q and the X, and then once we know the pricing kernel, we can solve everything in closed form. Okay, so what we know that from what does this model tell us that we can look at data. First of all, Treasury Inconvenience Yield. We're going to take the Treasury minus OIS. OIS is overnight index swaps, so that's the derivative, therefore much less balance sheet cost. And then what's more important, you have a repo spread delta T. That means that you earn some almost a risk-free rate. I think it is a risk-free rate during that time for the dealers. Right. So let's do the empirical evidence. So here is something interesting that initially motivated us to look at it. This is a Treasury OIS spread goes up, right? This is exactly that we are indicating that there are some balance sheet cost going up around that time. And here is the GCF minus tri-party repo spread. I never paid attention before this project on this object. This almost like 60 basis point of a spike of the GCF rate, which is the dealer's lending rate, so there's the money they earn, and the tri-party rate, which is the rate that they're financing. The spike up that really indicates the balance sheet cost that in our mind. Right. So I have 2 or 3 minutes on talking about 2008. In 2008. Things are just the opposite. So let me tell you that the way we think about the 2008 to 2020. Basically, in 2020, there's a lot of selling. In 2008, at that time, there's a lot of buying. Okay, and you can see here, flow is that everybody is just the opposite of things. Foreigners are buying, etc. So this is that Alvin and I are working on those things. We can modify our paper, our model slightly to accommodate the 2008 phenomenon. In 2008, there's no balance sheet cost, okay? However, that we know that in 2008, there's a lot of people try to buy, okay? And the dealers are standing there to provide the service to them, which means that the dealers have to short. And when they have to short, we introduce a short selling cost of gamma T, and this the relevant friction becomes the short selling cost. But the conceptually are very similar. On one hand, in 2020 is basically I have to rent the space to you. The other thing is basically you want it, and I have to find it and incur some cost to you. The implication when you go through all these things is that everything that we showed it to you on the empirical evidence side is just flipped. That a repo spread flips a sign because now that you have to find the security to deliver it. So this become this negative. It's relating to the Darrell's special collateral, that kind of stuff. And also the Treasury Convenience Yield then becomes a negative. So this is exactly what we find in 2008. That's the GCF minus tri-party spread, it's negative, while the Treasury Convenience Yield is also negative. So that's really a big, one consistent framework that captures both the 2020 and the 2008. I think I have 2 minutes, right? I started a little bit late. So what we also do is to, with this idea, then try to think about not only 2008, not only 2020, but the longer horizon, basically starting from 2006 to 2020, when we have the data on this GCF minus tri-party repo thing. And then here, what we show is that through some standard regression, try to showing you that what is the balance sheet cost revealed by this empirical object. The pre-TSLF, there's a huge negative line. That's just because of the specialty of this collateral. And then afterwards, it gets to almost 0. Here, this is a post GR goes up slightly, and then post SLR really goes up quite big. That's because it's reflecting the balance sheet cost. The same thing for the Treasury minus OIS, so that's very consistent. The last slides are showing you that we also do this quarter end. That's the usual kind of quasi instrument to showing you the balance sheet effect. So this is showing up as well. Okay, so let me just conclude on that. The conclusion that by looking at the quantity and the prices is basically during that time, intermediate sector struggled to absorb a negative demand shock for this. And we basically have a framework link not only what we observed in the 2020, but also link to back to the 2008 to give you a consistent story. Open questions here a lot. What motivates some larger holders to sell, especially the longer term ones, and not the short term ones. So we know that during that time, a dollar actually increases. A Treasury provided, Fed provided a lot of swap lines, and the short term there's a flight to quality, or flight to liquidity, etc. So we think that the long-term assets are more subject to coordination forces. Once you have the treasuries, the hedge funds selling, then they become very fragile. And why didn't other long-term unlevered investors step in? We do not know, because we're assuming that every dollar of these outside investors coming in, you need to go through the dealer's balance sheet. That's okay. I'm done.
Thank you, Zhu, thank you for keeping up with the time. We have about 10 minutes for questions. Anyone wants to start?
Yeah, I had a question. So one is, I was wondering, about your spread measures. So the convenience yield, doesn't that also include a liquidity risk premium? Because essentially, there's very little liquidity risk in trading OIS, and the Treasury became quite illiquid. Okay, the second is, about your repo spread. I'm kind of wondering how to interpret that, because the GCF, as you said, is an inter-dealer spread. It's mainly large dealers lending cash to smaller dealers. Yeah, so if the smaller dealers' bargaining position worsen during a crisis, which seems reasonable, that spread would go up, independent of what's whatever else is happening. I mean, in general, I think the way dealers do this is they run a match book. So they would take in collateral from the hedge fund, and then they will lend out the collateral to another customer, right? So I mean, I think ideally what you want is sort of the spread between the dealer's repo rate and the reverse repo rate. Yeah. But I guess that data is sort of hard to get. And then third point is, I think I'd be a little careful with the 2008 comparison, because the shock was very different. The shock was a shock to asset quality. So what you saw in 2008 was a shift from lower quality collateral to higher quality collateral, right? So if you look at the repo market, there was a lot of repo on lower quality collateral pre-crisis. So almost like completely dried up. And then everybody was essentially wanting to do repo on Treasury, which is why kind of the Fed had to come in and do the TSLF. So I think I think the comparison is not quite apples to apples. Thanks, I really enjoyed the paper.
Thank you. Let me just start from 3. I know that there are papers later on this like investment grade bonds. Right? There's a bunch of papers that I believe I would enjoy that. When you think about that way, and there are a lot of stories why this is the case, because all of a sudden we might think the catastrophe might happen. I think it's similar, and in a way that now it's become the question of whether Treasury will be bad assets or not. What I meant is that in the 2008, that's the MBS, etc. Here there's a bunch of corporate bonds are there. So that part of and there's one also factor is that the Treasury, there's a lot of Treasury in the right now, while in the 2008 there's a bit less. So in terms of which economic forces are more stronger or less, it is I think a jury is out there. The second one is that I want to clarify that we are taking the perspective that when the large dealer, they could also do some bilateral repo directly lending to the hedge fund. Probably we don't have these now. numbers. And then on the side, they could also do lending to the small dealers. So there's a equilibrium, equality that you can hold, equilibrium, saying that I could do this, so price gonna move. So that's the underlying logic that we're using the GCF number to proxy for the lending rate that they charge to the hedge fund. So you could have all these story about the bilateral bargaining, etc. It's all fine. That in the end, during that time, that they enjoy certain rights. The last one, liquidity versus the OIS. That's what I feel. That's it's as if the third question is quite harder to answer. And what we are looking at is the time change, and then maybe we could look at all these bid-ask spread, relative bid-ask spread between the OIS and the Treasury. Try to see that whether there are big spike in the moving in the same direction or moving in the opposite direction. I do know that the Treasury liquidity goes down. OIS, I do not know that much, but maybe that Stefan or Zhaogang has some information, they can jump in.
Can I ask a question?
Yeah.
So, I mean, there's presumably other participants that could have absorbed these bonds, like commercial banks are sitting on, $1.5 trillion excess reserves. I mean, what's the story for why they wouldn't do it? I mean, do you think their liquidity coverage ratios are binding as well, or what? I think there's this is SLR, right? Supplementary, that ratio. I believe, I didn't check, but from what I know is that they're also binding. It's basically, Darrell must know the details. When you calculated the SLR, it's must be at the holding company level, like a big.
Let me add one more piece. So the Fed also relaxed the SLR constraint at some point, which seems to have helped. So this would be consistent with the idea that the SLR at that point was, preventing at least some institutions to jump in.
Yeah. Some fine print on that. SLR applies both at the bank level and at the bank holding company level. The Fed relaxed it at the holding company level on April 1, but the OCC did not allow the banks to relax it until May 1. So you have some natural experiments in there. Also, the exemption applied to reserves and treasuries, but curiously not to treasury repo.
That's new to me. Okay, thank you.
Yeah. So sorry, can I, the liquidity coverage ratio for like depository institutions, right?
Mm-hmm.
If that's a resolution planning, that you can usually satisfy it with reserves or with treasuries as well. So that's a different regulation. I mean,
that's the liquidity coverage ratio. Yeah, that's what you mean. Yeah.
The LCR. I mean, different institutions that might have jumped in.
Very quickly,
who are not subject.
So the LCR, as far as I know, is not a problem for the banks because during the crisis, so usually the money flows to the banks. So because people they sell and they deposit their monies into the banks. So the banks are actually pretty rich in cash. So they are not kind of like in need of a lot of cash. So the cash already flow to them. So
the data shows is a very, very convincingly that during that time, there's a lot of cash sitting around in the bank. And there are a lot of firms are withdrawing credit line as well. So either side, the cash side seems to be very, very liquid.
And just a quick comment on LCR, actually, Zhaogang and I have a paper on agency MBS with my Fed colleague, Haoyang Liu and Zhegai Chen. So we actually compared dealers who belong to banks which are subject to LCR in the MBS market versus dealers who did not. And we found that the LCR dealers actually supplied more liquidity than the dealers who were unaffiliated with non-LCR banks, which suggests that, as Zhaogang was saying, the fact that they had to require to hold so much cash really kind of helped them provide liquidity and provide like arbitrage capital during this time.
So we have time for one more question. I will take a question from Marco Bassetto in the audience. You can ask your question.
Yeah, so that was very interesting. It's a nice story of how it seems that the two forces that you highlighted interact, because you still need this demand shock. And one thing that I was thinking is, you pointed out the inflation swaps, but if I look at gold, which is another measure of inflation hedge, that went in a very different direction. And the inflation swaps suffer from the fact that CPI has complicated issues with this crisis, because the basket completely changed of consumption. So I was wondering whether this is still consistent with a story that a certain group of people, maybe more sophisticated, saw problems with the long-term solvency of government debt, tried to get out, and then the people are left with all these liquidity issues that make things worse.
Yeah, so I'm following very closely on those different asset classes, or these things, but I don't think that time that the gold might go up. I have to say that I do not know, but what I do know that hit the headline is the recent, like gold just afterwards in the past several months on that. And what we are looking at is this period where the inflation expectation is low around that time.
But around that time, gold went up, and it dropped when the Fed stepped in. That's when gold dropped.
I see. So so this could be inflation, could also be the flow effect, right? So that's like it is consistent. You can see that these short-term assets premium goes up as well. So that's the similar effect. It's I cannot refute during that time, short period. If you see the price movement, I cannot refute the fact that it's just the quantity movement rather than the inflation expectation changes.
If I may add one comment, the fact that it dropped when the Fed stepped in, I guess that's hard to square with an inflation story, because that's the point where someone worried about inflation should have really gotten worried that the Fed is now stepping in with billions,
So can I follow up on that? So it need not be inflation. If you think the securities liquidity value depends on the supply, on the quantity, it could go through uncertainty about the quantity of these treasuries are going to be issued to pay for stuff you're paying for. You know what I'm saying? Even if you think inflation's anchored, just the fact that the quantity of these bonds might get unhinged because you need to pay for a bunch of expenditures, that might give you uncertainty about the liquidity value. And
Thank you for opening us for this discussion. Thank you. We're going to start now with Darrell Duffie, and he has 20 minutes. So we're going to go a little bit over time. That's fine. Thank you.
Thanks. I'll try to be very efficient. First, let me thank all of you for organizing. It's a perfect opportunity to talk about the issues that Zhiguo has started with. And in fact, my remarks are going to be so consistent with the primary hypothesis in the paper by Stefan, Zhaogang, and Zhiguo that I think you're just going to hear the same story again, but from a different perspective. I'm going to focus on where the balance sheet costs are coming from and on market structure, because this paper was triggered by the Brookings Institute that wanted to know not only what happened, but what should we do about it. And my suggestion is that we focus on market structure rather than trying to relax the balance sheet costs, because the only way to relax the balance sheet costs, in my view, is to relax the capital requirements significantly, and I don't think that's a good idea. That's what got us into 2008. So let me launch into this. A quick story, there was a dash for cash on March COVID news. A whole lot of treasuries were sold, but because almost all bond trades by investors must be handled by dealers, this is the central part of my story, and in particular by large bank dealers who do the lion's share of the entire intermediate. Because the balance sheets of the dealers are now heavily constrained by regulation, bond market basically choked on the transfer trades. There just wasn't enough balance sheet space available under capital requirements to handle the trades. And for obvious reasons, the dealers were not going to issue a big new slug of equities in the secondary equity market just to handle these flows. So basically, there was no space left on the shelves of the dealers to handle the flows. And I'll talk more about that. I'm not so excited today about talking about what central banks did at that time. I want to talk about what they could do about market structure. But basically, this happened in many different countries. Central banks stepped in enormously. The Fed was the most aggressive. It will have purchased $2 trillion of agencies and treasuries by the end of the year because of this issue, not for quantitative easing purposes. And of that, $1 trillion of treasuries alone was purchased in the first 3 weeks after the March COVID news hit the treasury market hard. I'm not going to review the other central banks, but they're also doing programs of similar magnitude relative to GDP, enormous, and because of market liquidity issues, the quantitative easing is done in separate programs. So first, as I said, I want to focus on market structure. This is just a schematic showing how the treasury and other bond markets work, where the blue dots are investors, customers of the dealers, and all of their trade requests are intermediated by dealers, either directly in bilateral or indirectly, well, through dealers in multilateral trade platforms. The dealers themselves can exchange bonds in a more organized, efficient way on a central limit order book for the on-the-runs. And the dealers also have other facilities for more efficient interdealer trade, which I'll discuss. But basically, we're still back in a very old market structure, which is not suited to the kinds of flows of and for trade. And I'll get to that later in the presentation. So the implications of that, where every investor bond trade must be intermediated, must be handled by a dealer. You have to sell to a dealer or buy from a dealer. Well, you need to look at the available space on dealer balance sheets. Stay with me for a couple of minutes while I talk about this chart, which is a very broad brush, rough look at how much treasuries there are to intermediate, shown in blue. That's the total outstanding amount of treasuries. And on the right-hand side of the chart, you can see, I don't know if my Zoom features are in a way, you can see that treasuries are going to grow astronomically in the next few years, even faster because of COVID and huge government deficits. Okay, so that's the story of treasuries. The quantities are in trillions on the left-hand axis. In red is the total size of the balance sheets of the major US primary dealers. Now here I did not include the foreigners, but most of the market is done by US anyway. And you can see that pre-crisis, the balance sheets of the major dealers at the holding company level tripled on light capital requirements leading up to the financial crisis. For 10 years or so, about 3 to about 10.5 trillion in balance sheet size. Again, not enough financial regulation, jet fueled by cheap debt funding costs, the balance sheets grew enormously. Then post-crisis regulations set in, and the dealer balance sheet costs in red have hardly grown at all. They're now on a kind of a steady state, slow growth path, which is far lower than the growth path of the outstanding amount of treasuries. So if we think that the treasury market was too big relative to dealer balance sheets in March of this year, just wait until the next market crisis, because it's going to be a lot worse unless something is done. And again, I have not added to the old days in which dealer balance sheets were very elastic because there were hardly any limits on capital, and also because of the too big to fail problem, both of which have been addressed. So now, assuming I can march forward, I'm going to skip that slide. It's basically the same story, but focused on treasuries, and get on to the thing that happened in March. Vertical axis is frequency in months. This is a histogram. On the horizontal axis is the foreign gross sales of US Treasury securities in trillions of dollars. Now, in Zhiguo's presentation, there was a focus on net sales of treasuries. In my view, the better focus is on gross sales, because this is the amount of treasuries that have to be handled by the dealers. It's a pipeline issue. So if there was a net foreign sale of 100 billion, that could mean that either 100 billion was sold and 100 billion was bought, or it could mean 1 trillion was sold and 900 billion was bought. There's a big difference in terms of the amount of balance sheet space that's taken up by the dealers. And so on March, that was the record high of the entire post-2000 sample. 2.7 trillion of treasuries were sold in that month, in the month of March, by foreigners. That's just the foreign sales. That's not counting all the US mutual funds and everybody else in the US. And remember, all of those sales, which are to US residents, must go through US dealer. There's nobody else buying from non-dealer investors than dealers. So Zhiguo's story about balance sheet really comes into play. If you have a balance sheet that has to handle 2.7 trillion of incoming sales and you need to intermediate those, they're going to sit on your balance sheet for at least a day or two, probably two or three. Industry estimates around 3 days is the time in to time out. Remember, there's T+2 settlement, and there's search time to find buyers. So that's clogging up the pipeline of sales that have to sit temporarily on dealer balance sheets. And this is why the Fed stepped in, because the dealers simply couldn't handle the volume, and the Fed basically hoovered up 1 trillion of treasuries in 3 weeks to reduce the amount of treasuries that the dealers had to handle. What happened in terms of bid-offer spreads? This is a chart from the head of the System Open Market Account and Trading Desk at the New York Fed, Lori Logan, which is indexed to 100 at the beginning of the year, is the bid-offer spread on Bloomberg. So this is the bid offer to investors, not in the interdealer market. And it indexed to 100, it stayed pretty constant until March. And then, wow, it went up by a factor of 12. The bid offer spread was basically telling investors, yeah, we'll intermediate a few more bonds, but only at an enormous bid offer spread because we're stuffed. Our shelves are overloaded. We'll only make space at very high bid offer spreads. What about in the interdealer market? In the interdealer market, Market Depth, BrokerTech platform in New York, went from a typical late February level of about 175 million at the best 3 quotes, down to about 10 million at the best 3 quotes. This is for the 10-year on the runs. There's similar work that's been done by Michael Fleming, who I think is here today in much more detail. That came out subsequently to this JP Morgan analysis. Same story in London and Tokyo. Those markets are smaller, but a similar crush. So basically, the amount of liquidity provided in the interdealer market also almost disappeared and then recovered when the Fed came in. So what is this evidence of? Well, it's the same. It's evidence of the same phenomena discovered by Du Tepper and Berdellen in the covered interest parity basis, which basically said at quarter ends when balance sheets are measured, dealers do not want to intermediate those markets. So the effective cost of getting balance sheet space in the cross-currency basis market goes way up. And this is on an ongoing basis, evident in many different markets. But in March, it was most evident in the cost of getting balance sheet space with the dealers. So this is about balance sheet space. Zhiguo is right on the mark. Zhiguo, Stefan, and Zhaogang are right on the mark on that. I've presented this paper many times. This is the first time I'm going to try to give a conceptual or theoretical foundation without going into theorems and proofs. So the basic idea of the story is you're running this balance sheet. You have assets, you have debt, you have equity. And now someone wants you to buy a lot more assets and you need to fund it. So for example, someone says, will you take my new assets? And you say, well, my balance sheet is stuffed. If I funded it with all equity, by the way, the banks don't do that. They use a mixture of debt and equity, but if they're up against capital requirements, they need some new equity. But if they funded it with all equity, then what would happen? If you draw these colors in market value terms, and you have a lot of new assets and the same amount of debt, well, then the debt is safer. And so in market value terms, the debt is worth more. The new equity is funding the new assets 1 for 1. So the old equity market value must have gone down. This is just classic debt overhang. It must be the case that in order to provide liquidity to investors who are selling you assets, you need to lose money for your shareholders. Well, you're going to say, of course, I'm not going to lose money for my shareholders. I'm going to raise my bid offer spread so as to overcome that wedge caused by debt overhang. Now, this is just straightforward Mahyar's theory. In a recent paper with Leif Anderson at Bank of America and Yang Song, now at the University of Washington, we actually quantified this. And you can quantify it quite simply without investor parameters, risk aversion. You can just do it directly in terms of very simple the dealer credit spreads and a couple of other observable variables. And you can do it both for equity funding and for mixes of equity and debt financing. And you get very concrete, reasonable formulas. All that said, our formulas are for discretionary expansions of balance sheet. In March, the dealers were in an emergency situation. The amount of funding they needed was only going to be met if they tried to meet it in full by issuing new equity, which they just weren't going to do. So there was a fixed constraint. I think of March as a fixed constraint on balance sheet space. Remember in Zhiguo's presentation, he talked about other impositions on balance sheet space, like repos. Well, there was not just repos. Borrowing customers, corporate borrowers were drawing on revolving lines of credit enormously. There was hundreds of billions of revolvers that were drawn. That was expanding balance sheet space requirements. There was foreign exchange requirements. There were big new margin requirements on swaps because volatility was a lot more. So basically balance sheet space was getting in very high demand from all directions in March. And the Treasury trading desks would, call up to the CFO and say, we need more space. And the CFO would say, only if you're willing to pay a lot for it. And that's basically what happened. Now, what to do going forward? I'm going to watch and see how much time I have. I have a few minutes. So I want to talk about what to do about the market structure that's causing this problem. What is the market structure that's causing this problem is that every trade must go through a dealer. If that's the case, then dealer balance sheet space is what needs to be conserved. So one way to conserve dealer balance sheet space is central clearing. Let me explain the idea. Suppose Stefan wants to sell bonds to me, and I can on-sell those bonds to Bruno. Well, I'm going to have commitments to buy and to sell that won't be settled for another day. And that's at a minimum, assuming that I can immediately match them. So that expands my balance sheet. And when I'm, as a dealer, I'm trading with Zhaogang, our trades can be centrally cleared at a central counterparty, which is the Fixed Income Clearing Corporation for Treasuries. And the buy against the sell can be netted down immediately, intraday. So the amount of balance sheet space is much smaller. When you consider the fact that trades do take longer for which to find counterparties, and the implications of settlement fails, which I'll talk about later, plus the similar implications for the repo market, which are, in terms of netting, also very large. The ability to net down at a central counterparty is very beneficial in terms of balance sheet space. However, in the current market, it's estimated that only 22% of all transactions have you facing the central counterparty through netting. On the other 77%, 77.5%, there's no netting at a central counterparty. So a market structure that has all major market participants in treasuries centrally clearing their trades is going to net down a lot more and save a lot of balance sheet space. So I'm just going to read the caption to this figure. a rule, meaning a regulation, which I've suggested that regulators consider, which has been suggested even by Treasury Market Practices Group, market participants, a regulation that requires the central clearing of transactions of all firms actively trading treasuries would relieve some of the need to warehouse these trade flows on dealer balance sheets. Dealers would be better able to net their buy and sell trades with central counterparties. And now, probably more importantly, with a broad market central counterparty, some of the transactions could flow directly from ultimate sellers to ultimate buyers without necessarily ever impinging on dealer balance sheet space. Well, why is that? That's because exchanges will say, wow, there's a central counterparty that everybody is clearing through. That means I can set up all-to-all trade with straight-through processing using either a central limit order book or request for trade protocols. And now many traders will be able to trade treasuries without calling a dealer. The dealers would probably not appreciate this because they're going to get disintermediated, but the amount of dealer balance sheet space necessary to intermediate the treasury market would go way down. Dealers would still be in the picture in a big way, just as they are now in other markets like equities. But they wouldn't need to be there for every single trade. We wouldn't be so dependent on balance sheet space. And everybody agrees that the dealer balance sheet space should be constrained by regulation, so we need another approach. I'm watching the time. Do I have any more minutes or not?
2 minutes.
2 minutes, okay. So let me finish up in 2 minutes. Some have asked, well, aren't treasuries huge relative to equities? How could you possibly clear those large trades? This slide shows the one single equity, the SPDR, I picked a big one, the amount of one-day settlement risk on SPDR versus the largest, most traded treasury 10-year note. And you can see that it's already the case that centrally cleared equity markets are handling bigger settlement risk than in treasuries. In fact, the equity risk is 2 days because it's T+2. Treasuries are only 1 day. So it's technically quite feasible. Also, it would mitigate settlement fails. In these vertical bars here, the amount of settlement fails in the treasury market, and they are both primary dealer fails and also centrally cleared fails. They both went up, but the primary dealer fails were much bigger in March on the big news. This is the red bar versus the blue bar. Why is that? Well, one possibility is that in the bilateral market that's not centrally cleared, if I don't give the treasury that I promised to Stefan today, then he cannot give it to Bachimeg on the trade to her, and she cannot give it to Bruno on the trade that she promised to him. So you get these daisy chain failures that market participants have discussed. If on the other hand, we use central clearing, there can't be daisy chains because all trades go through the central counterparty. So that's also central clearing is good simply for financial stability reasons because it reduces counterparty risk, which is one of the concerns in the treasury market. So that ends my discussion of yes, the balance sheet space seems to be the smoking gun. And no, we don't need to relax capital regulations to deal with this problem. With the enormous growth in the treasury market, we should address the market structure and mitigate the shortage of balance sheet space, possibly with central clearing. I've suggested that regulators do a quantitative analysis of what central clearing would mean for the treasury market. And I've been talking to them, but we have time to discuss that now. So thanks very much.
Thank you. We can start with a Q&A question. So Mohammed asked why this is not a movement that's happening naturally and we are going for central clearing. What is it? Is it the problem of incentives or coordination?
It's a market failure associated with coordination and private interest. So I mentioned before, suppose I am the dealer intermediating these trades with investors. What incentive do I have to help the market set up central clearing? Well, not very much, because first of all, the market gets more competitive if all-to-all trade happens. And so my bid offer spreads will go down, and the fraction of trade that I intermediate will go down. So I lose on quantity, I lose on price. Why would I be in favor of this? And the hosts, basically it's the primary dealers that are hosting the treasury market. So it would, and the Treasury Market Practices Group talks about this conflict of interest. And they suggest as well that this is a situation in which only the official sector could make something happen.
Darrell, I have a question over here. So
Yeah,
what about the end users, you know, the big funds, the BlackRocks, the Vanguards, the Fidelities? What stops them from doing like a dark pool, if you wish, in treasuries where they say, look, we're going through you guys, the dealers, and maybe if we just limit ordered it ourselves through a side venue, and there's no small traders here. These are all big guys in general, right? So it seems a little odd that those incentives don't exist.
Well, first of all, let me say that I am conflicted in the sense that I am involved in, as an expert witness on litigation about this in the swap market, where basically the same discussion was had, and it's a complicated industrial organization issue. The largest trader, the very largest traders are not going to be that much affected because most of their trade is going to go through dealers anyway. And they don't want to bite the hand that feeds them, in my view. Whereas most other buy-side firms are much more benefited by a more all-to-all market structure. And they have complained in the swap market, and there has been a lot done. There was also a mandate, a regulation of the form that I described earlier for the swap market, by which central clearing went from under 10% of the market to now over 90%, merely because of a regulation. And what happened to market liquidity? Well, that in combination with the request for trade platforms that were mandated in Dodd-Frank has reduced bid-offer spreads by a factor of 10 in the interest rate swap market. So my presumption is that something similar would happen in the treasury market. There was no natural market forces to push for the effect of those regulations, Dodd-Frank regulations. It required the interference of the official sector. And I think it's a very natural market failure to expect.
Darrell, can I ask a question?
A word? Can I say a word?
Okay, go ahead, Bruno.
Yeah. Well, thank you, Darrell. I really love what you just told us. It's great. So there are two levels, basically. One level is the market where trades are matched, and the other level is the clearinghouse where trades are cleared. And I think one of the things I learned from your paper, from your presentation, is that it's hard to have a market if you don't have a centralized clearing. It's hard to have a centralized market if you don't have a centralized clearinghouse. So I think that's a really interesting point. And maybe another point that I'm taking from what you said is that there may be a coordination failure, especially at the level of the CCP, because at the level of the CCP, there may be some economies of scale. There's a fixed cost of setting up the CCP and running it, plus the insurance benefits from insurance against default risk from having the CCP is going to be large only if there's a large number of people.
Yeah, so your remarks are all, as usual, Bruno, you're right on the point. You can't have a central limit order book unless you have straight through processing to central clearing. Among other things, who is going to trade with an anonymous person unless the trade is centrally cleared? But then there's all the intraday netting, and you just can't do it. There's no immediate execution possible without a central clearing. That's why every exchange market in the world has a clearinghouse. And I think you already basically covered the rest of your question by a comment. So in the interest of time, I think I'll just leave it with your comment.
Can I ask a question, Darrell? So you had a slide, the one where you justify why they wouldn't pay for the assets with issue new equity. The debt overhang impedes arbitrage slide. It would hurt the current stockholders, because of debt overhang type arguments. I mean, did that logic take into account the capital gains from buying cheap assets leaning against the wind? Is that factored in there as well, or?
Yeah, so in the paper I wrote with Leif Anderson and Young Song, that's completely factored in. We show the cost benefit of, you get the bid offer profit, but then only some of that profit goes to the shareholders. The remainder goes to the creditors through the improvement in the quality of the balance sheet. And so it's only valuable to intermediate a trade when the bid offer spread exceeds some number. And it turns out that if it's all debt financed, that number is the cost of unsecured funding, the credit spread of the bank for the period over which you're going to expand your balance sheet. So if your credit spread is 50 basis points over a year, and you're going to expand your balance sheet for a year to hold this trade, then you need a 50 basis point intermediation profit to justify the trade. If it's partly equity funding, that goes up, but not as much as you might think. So for a typical bank, the cost per year for expanding your balance sheet goes from about 35 basis points for all debt funding to about 42 basis points if you include equity funding subject to SLR. So basically, these banks, we're thinking in terms of 50-ish basis points annualized bid offer or bid to mid spread needs to be obtained. However, that's on an ongoing basis. In March, there's no way that they were being held up by a few basis points just to intermediate. It was really more from a practical viewpoint, which bank is in the middle of March going to say, you know what, if we only had another 100 billion in equity, we could intermediate to make some more profit. So we're going to do a secondary equity offering in the middle of a crisis. It's just not going to happen. So basically, there was a temporary hard constraint. It was not the same kind of trade-off that I described from my paper.
We have time for
Darrell,
one
about
yeah, I was going to open. So one last question from
okay. About the diagnosis of the problem in March of this year. So, the story you're telling is that an interested seller cannot be connected efficiently with an interested buyer, right? Now, this sounds like a temporary problem that would eventually have resolved itself even if the Fed had not stepped in. So I just wanted to hear from you whether you think that's sort of the right description.
I absolutely agree.
Now, the Fed stepped in and kept sitting on those treasuries. We don't exactly know what the counterfactual is if they had not done that, if they had tried to release the treasuries back into the market. But this makes me wonder of, whether this is more than a temporary problem due to failure to connect buyers and sellers.
Yeah, so it's a pipeline problem. So it's not just how long does it take to find a buyer, but how long what's the half-life of your inventory once you get a surge of demand? And that demand was going to continue surging and might have even been exacerbated had the Fed not stepped in by additional dash for cash. So all of the indications that I gave of intermediation quality, they went down when the Fed initially stepped in, but it took about 6 weeks before they were close to normal again. If the Fed had not stepped in, we would have had a much longer duration of market dysfunction. And it wasn't immediately diagnosed what was going on. So the safe thing for the Fed to do was just hold a whole lot of treasuries and continue to hold them while there was any question. I just have some concerns about the moral hazard of market structure that relies on the Fed to rescue the market. On a normal day, there's no problem. The bid offer spread in the treasury market is really tight and there's tons of liquidity available. So it's just really on a surge of demand for trade.
Thank you, everyone. This was a very successful first session, and we are gonna reconvene back at 1:10 to continue our workshop. And of course, we can stay here and hang out and talk about the papers.
Darrell.
Yeah, Drew.
Stefan's question is exactly my question as well. We basically look at the quantity around that time, right? And then you can ask a question, what happens afterwards? Almost like a half a year now. Okay, so what we find is that all these intermediation is back to normal, right? The balance sheet get back and all these things. But the balance, all these treasuries seems to be all sitting on the Fed balance sheet. It's like it's going up and then it's getting flat. It's still there now. I can
Still
send you
growing.
the picture.
It's even
So
still
this is
growing.
the-
It's still growing by 120 billion a month.
Yes, exactly. So then it gets the question, is this something that, counterfactual, if they sell, is this going to get another big market turmoil? Or, because that gets to the center of the question, is this like really the problem is just the inefficient matching, so therefore it's a liquidity kind of high frequency problem, or longer demand, supply, safety, all these things? This is what I don't think Stefan and I will agree each other, or nobody knows the answer, it seems.
Well, I think it was a high frequency problem, but that wasn't going to get cured in a high frequency way as long as the flows kept happening. And that's an endogenous thing. As long as the market is dysfunctional, the flows will continue to be problematic, volatility. The Hupan Wang measure of market misperformance of the treasury curve was really bad. Yeah. I think also there's some, consistent with Stefan's remark and yours, the Fed was maybe being extra conservative with some stealth quantitative easing because they didn't want treasury yields to get too high on a short-term basis. And so they just said, at the cost of expanding our balance sheet, it's probably worth it to slide in some treasury yield control of a certain amount and just, play it safe. And I think that was probably prudent. They advertised that it was all about market functionality. And probably after the first couple of trillion, the rest is more about quantitative easing.
Thank you.
Darrell, to kind of add a kind of data point to what you're saying, it's kind of interesting that the net positions of the dealers generally increased during those critical weeks, other than corporate and commercial paper, which was kind of different from 2013 during the taper tantrum. And then in some markets like agency MBS, our paper shows that the dealers were actually buying the spot contract when the customers were saying. So, so my sense is that the reason the dealers couldn't accommodate the full amount of force setting was just overwhelmed by it, and maybe they ran into some value at risk limits. So I think this idea you're proposing of just shrinking just the amount of inventory management they have to do is like right on spot.
And also, Darrell, that I kept thinking when you're proposing these centralized thing, it won't be a problem at all in China, I would guess. And
Yeah, I'm actually on the advisory board for the Shanghai Clearinghouse, which does all the clearing for CGBs, and that's basically a piece of the PBC that runs this in China. The Shanghai Clearinghouse is part of the PBC, really.
Yeah, this SCH, right? Shanghai.
Right.
Yeah, Shanghai Clearinghouse. Yes.
So they are, but I don't think there would be any concern in China about imposing this requirement if it was viewed as important for market functioning. In the US, there's more concern because the policy issue involves some winners and losers. The losers would be the primary dealers if it came to all-to-all trade. The primary dealers would gain a bit in terms of the cost of doing trades for the existing market structure, but there's it's a Trojan horse for all-to-all trade, which they would not like to see.
Yeah. But my real question is that I think there are also multiple clearing houses because each exchange has its own clearing house. Is that right?
Yeah, but the swaps and CGBs are cleared at the Shanghai Clearinghouse. The equities are cleared, and the futures are cleared at the
But Treasury can be traded. Treasury in China can be traded in different exchanges. So they are also, maybe it's okay. It's just a 103 centralized clearing houses. It's not.
It's the interbank market that's cleared at the Shanghai Clearinghouse.
Darrell, you say it's not a good idea to play with capital requirements on balance sheet costs because they have their own justification for financial stability. But maybe there are less drastic policy tools. No? Perhaps we could delay reviews of those balance sheet requirements for a month if it's a temporary
Yeah, that's exactly
problem.
That's exactly what the Fed did. The Fed just completely exempted Treasury securities from the supplementary leverage ratio rule on April 1st. So that was basically what you're suggesting, and they did it temporarily for up to 1 year. And I'm not a fan of the SLR, but I think they're probably going to continue the exemption for reserves, but maybe not for treasuries, because they are risky.
Precedent and things like
Treasury
that.
securities are risky. The 30-year bonds lost 10% of their market value in 2 days in mid-March.
Yeah.
So the idea that there's no capital requirement needed for treasuries is just not right.
All right, so we're gonna move on to the second session of the workshop. First, Mahyar Kargar, he's gonna present corporate bond liquidity during the COVID-19 crisis, co-authored with Ben Lester, David Lindsay, Shuo, Pierre-Olivier Weill, and Diego Zuniga. Okay, go ahead, Mahyar.
Hey, thank you. Can you guys hear me? Yes? Okay.
Yep.
Good. So first of all, I want to thank the Search and Matching in Macrofinance for helping us organize this workshop, and to all participants for attending and presenting their interesting papers. So the usual Fed disclaimer obviously applies. So the $10 trillion corporate bond market is a major source of funding for firms, particularly in this pandemic where the shock was actually at the corporate sector. However, it seemed like when firms needed to access the corporate bond market, the most in mid-March, there was a lot of distress and extreme illiquidity in the corporate bond market. Specifically, the credit risks went up. Credit spread for the AAA bonds went up by a factor of 4. Customer to dealer volume went up by around 50%, indicating a large selling pressure. And also there was massive fund outflows from mutual funds and ETFs. In response, the Fed announced unprecedented actions in late March as the market maker of last resort. So in particular, what we're interested in this paper is the revival of the primary dealer corporate primary dealer credit facility, and also the announcements of the primary and secondary market corporate credit facilities, in which Fed for the first time actually announced that it would be buying corporate bonds and ETFs in the primary and the secondary market. So what do we do in this paper? We study liquidity conditions in the corporate bond market and the impact of the aftermath and of the Fed interventions in the market that I just alluded to. So crucial for our study is that we consider both cost and the quality or speed of intermediation services in our analysis. So we can think about it this way, that there are multiple channels through which the market liquidity could deteriorate. One of them would be customers facing higher transaction costs, or they could also face longer waiting times to execute their trades. We propose a very simple model that not only guides our empirical work, but also translates what we observe in the data to what at the end of the day policymakers would care about, consumer surplus and dealer profits. What do we find? We find that during the height of the crisis, dealers basically were reluctant to absorb bonds onto their balance sheets. And as a result, the price of fast, so-called risky principal trades in which dealers use their balance sheet space went up quite substantially. And in response, customers substitute towards slower so-called agency trades. They actually do not use the balance sheet space of dealers. And what's most striking in our results is that during the worst of the crisis and right before the announcements of Fed facilities, dealers basically were net sellers. They're not only lean against the wind, they just started selling in droves. And after Fed intervened, we see significant improvement in the liquidity conditions in the corporate bond market. Immediately after the announcement, we see that the eligible bonds for the SMCCF show a significant improvement in liquidity. Then later, after these facilities were expanded on April 9th, we see a wide variety of bonds actually show improvement in liquidity. And again, I'm emphasizing here that we find that this distinction between cost and quality actually matters for welfare. So if you just look at the average transactions cost, you're going to miss out a big portion of loss in consumer surplus due to this substitution effect that I just alluded to lower quality agency trades. Also, dealer profits return to pre-COVID levels, although we have elevated volumes and still higher transaction costs because the cost of provision of these trades actually are still elevated due to higher volumes. So in the interest of time, I'm going to skip the literature review, but you're going to see most of this relevant papers that I highlighted in blue already in this seminar. So as I mentioned, we distinguish between two types of transaction services in emphasizing both cost and quality of transactions. So one is the so-called agency or pre-arranged or riskless principal trades, in which basically customers maintain the possession of the assets after contacting dealers, while dealers look for a suitable counterparty for the trade, and trade only happens when a counterparty is located. So for a customer that cares about speed, these are low quality transactions because customer has to wait. And for a dealer which cares about balance sheet costs and other funding costs, these are low cost transactions because the dealer acts as a matchmaker. They don't really lose balance sheet capacity. So on the other type of trade that we focus on is the so-called risky principal trades, in which customers trade immediately against dealer inventories. For a customer, obviously, that cares about speed, these are high quality because of the provision of immediacy. And for a dealer, these are high cost transactions because they use up balance sheet capacity. So now I want to talk about a very simple model that'll help us think about the empirical findings that I'm going to show you later. It's a simple model, as I mentioned. There are a measure N of customers. Each customer has a unit demand for transaction. And there are two types of transactions, low and high quality, basically representing this agency and risky principal trades. And the customers just choose a fraction of their agency principal trades, subject to the total demand being equal to 1 unit. And the other side of the market, there's a representative competitive dealer that supplies the transaction services subject to some convex cost function C, which we think would just represent balance sheet costs or maybe funding costs that the dealers would actually face. So we see a COVID-19 episode as an exogenous shock to demand, a selling pressure that happened late March. So we look at some comparative statics in the lens of our model. So the question we're trying to ask is, what happens if we see an increase in the measure of customers that come to the market? This N goes up, what would the impact on the prices of low and high quality transactions? So we assume for the moment that there are no contemporaneous supply shocks. We assume these costs of provision from the dealers are remaining constant during this episode. Later, I'm going to relax this. If I have time, I'm going to show you something about that as well. So we find this using a simple implications of the implicit function theorem under some natural conditions that as N goes up, the prices of both type of trades, low and high quality, would increase, but the price of high quality transactions, those risky principal trades, goes up by more. And as a result, we see substitution towards a lower quality agency trades, so that the fraction of risky principal trades, high quality trades, would decrease. And although it's not part of our model, but if you think about Fed intervention, relaxing some costs, the dealer balance sheet costs or other type of costs that the dealer faces, reducing this C, then you should expect some mitigation in these effects that I just alluded to. So we use the trace data to actually look and test these empirical implications in the data. So I'm quickly going to talk to you about how we measure these types of transaction costs for these two types of trades. So for agency trades, as I mentioned, these are like matchmaking trades. So dealers search for a counterparty on behalf of customers. And once the search leads to a suitable counterparty, the trade happens. So we'd expect to see two customer-dealer trades happening in a quick succession. So one buy and one sell, and this is, and then once you do that, it's really easy to calculate the transaction costs. You just look at the percent change between difference between the price at which the customers sell to the dealers minus what the customers buy from the dealers. For the other type of trades, the high quality risky principal trades, we use a measure based on Choi and Hu, You can no longer use that percent change approach that I mentioned because you don't know how long the bond was at the dealer inventory. So we look at round trip costs by looking at the difference between the price and a reference interdealer price, which we define as volume weighted price of interdealer trades that happen in the same bond day. And importantly, we exclude our previously identified agency trades. So this is the time series of these two types of transactions. The red one is the high quality risky principal trades, and the blue one is just the low quality agency trades. So consistent with the model, we see that during the height of the crisis, the transaction costs for both of these trades went up, but much more dramatically for the risky principal high quality trades. So we see it went up from around 25 basis points to around 250 basis points right before the announcements of the primary dealer credit facility. And less so for the agency trades, which went up around from 8 to around 28. But you see after the announcements of these facilities by the Fed, trading costs went down, but not quite to the levels that we observed before the pandemic started. And as for the substitution effect, so this here we plot the daily fraction of agency trades by number in blue and by volume in red. We see that during the crisis, we see a jump of around 15 percentage points in the volume of agency trades on a daily basis. Again, after crisis, this is subdued a little bit, but not quite back to the levels we observed. Again, we show this in a much more formal setting in a regression framework that's in the paper, so I'm going to skip this formal way in the interest of time. So a natural question that you might have is that who provided liquidity in mid-March when we see this massive selling pressure? Who was the liquidity provider? Was this the dealer sector that leaned against the wind, or was it customer sector that actually ended up providing the liquidity in the market? So this is the cumulative inventory of dealers that we built based on the data from the aggregate data from FINRA. So this is difference from the volume of customers sold to dealers minus volume of customer bought from the dealers. So what's striking here is that we see that during the height of the crisis, dealers not only leaned against the wind, they actually became net sellers. And only after Fed intervened on March 18th and after 23rd, we see this inventory start picking up. And actually, in fact, we see a massive buildup of inventories since March 23rd by around $50 billion. To put that in perspective from the flow of fund, this is almost doubling inventories of dealers in the corporate bonds. So we might think that basically this graph that I showed you might indicate that Fed intervention had impact in relaxing dealers' balance sheets and improving liquidity in the bond market. So we want to test this a little bit more formally and exploiting the fact that there are different criteria for eligibility for this SaMMF program that I mentioned earlier. Oops, sorry. So the eligibility criteria on the first term sheet of the SaMMF on the 23rd specified that the Fed would purchase US bonds that have investment grade rating and also have remaining time to maturity of less than 5 years and some other criteria. So the question, as I said, we asked, did this intervention improve the eligible bonds liquidity by more? So we use a difference in difference strategy on US bonds before and after this SaMMF announcement. But before that, so we want to see if there are any spillover effects to non-eligible bonds. So we run just a simple regression. And the left-hand side, we have the transaction cost of agency or principal trades. And we have dummies for the crisis, which is defined on March 5th to 23rd. And the SaMMF, which is the dummy for right after announcement on the 23rd, before the expansion on April 9th, and then expansion, which is the time period after. And we define eligible bonds as investment grade bonds, which have time to maturity of less than 5 years. So for the interest of time, I'm just going to focus on column 3. So we see, if you look at first column 1, we see during the crisis, compared to the pre-crisis period, we see a massive increase in transaction costs for the risk of principal trades by around 106 basis points. And then after the SaMMF announcement from March 23rd to April 9th, we see that the transaction costs went down and then went down further after the SaMMF expansion. But we see no impact on the liquidity of the risky principal ineligible bonds right after the SaMMF announcement. So all the decline in agency in the transaction costs of risky principal trades were due to the eligible bonds. So this is just the standard diff and diff to basically identify the impact of SaMMF announcement on the transaction costs for the eligible bonds. The left-hand side is the same as before, the transaction costs for the agency and risky principal trades. And also we focus on bonds that do not change rating during our time period. And we're focusing on trades before the April 9th expansion of the SaMMF to include falling angels. So if you focus on column 1, so the first key takeaway is that the SaMMF had significant effect on cost of risky principal trades for the eligible bonds relative to the ineligible bonds, which as I showed you, were essentially unaffected during this immediate period of announcement of SaMMF. So we do a lot of robustness checks and different columns and different tables, which again, I don't have time to discuss. I refer you to the paper. Interestingly, as you see, the coefficient on the SaMMF dummy is not statistically significantly different from 0. This is again an indication that the announcement of the initial SaMMF had no spillover effect on the risky principal ineligible bonds. So in the last two columns, column 3 and 4, we do the same, but for the agency trades, again, we see an impact on reduction of the trading costs for agency trades for eligible bonds. And one possible explanation, as you remember, these are the bonds that dealers do not actually hold in inventory. So one possible explanation for the drop in transaction costs might be that basically Fed became the buyer of last resort. And this actually reduced the risk for a private investor from holding these eligible bonds. So that's why you see it's maybe easier for the dealer to find these bonds and make the trade happen. And also you see on the SaMMF dummy, we see a positive and significant spillover effect to ineligible bonds. Again, you can think about this because maybe private investors have basically have budget constraint. So after the announcement, they just switched to eligible bonds, and it was harder to find and locate these ineligible bonds for agency trades to take place. Again, we do a lot of robustness checks. We look at around the threshold of investment grade and time to maturity, and we see even results become more significant as we get closer to the definition of the eligibility. So in the final part of the talk, I'm going to talk about the welfare implications of what we basically measure from the data and what our model basically shows us. So if we going back to the model, we can just write down the consumer surplus as the utility minus the cost of acquiring these basically risky principal and agency trades. So if you use a simple application of the envelope theorem, you can write down the change in consumer surplus and decompose it into two parts. One is due to transaction costs, and the second part is due to the change in quality. So basically from our model, we can easily calculate the change in surplus because as I shown you earlier, we have time series for the prices of agency trades, the prices of risky principal trades, and a fraction of the two. So we can actually easily calculate this change in surplus through the lens of our model. And importantly, if we just focus on this first part, if you just focus on the increase in transaction costs, you just kind of miss the reduction in the surplus due to the substitution effect to lower quality transactions. So what we do here, we just actually plot this change in consumer surplus, and in the red curve, it is the total change in consumer surplus. And in blue, we just plot this first piece that it's due to the change in increase in transaction costs. So basically what this plot shows you that if you just consider transaction costs, you're doing a pretty good job during the crisis. So most of the, basically almost all of the loss in transaction cost, loss in surplus was due to the increase in transaction costs. But later after the Fed basically announced these facilities, you see that the gap starts opening up, and although the transaction costs were still elevated, as I showed you in the plot, so you're going to miss this substitution effect that also reduces the consumer surplus if you just focus on this blue curve. So we do similar things for the dealer profit. Again, we decompose dealer profits into revenues minus something that depends on the volume, and then minus something that basically takes care of the substitution effect. Again, so consistent with what we learned during the crisis, we see a large increase in dealer profits during the crisis from March 5th to around March 23rd. But you see the profits kind of came back to pre-COVID levels, even though the volumes and the transaction costs are still elevated. And this is because of the reason that the cost of providing these transaction services actually still elevated because of the higher volume. And last thing I wanted to show you that so far I just basically emphasize.
You're running out of time. So
this is the last thing I want to show you. It's going to take 30 seconds. So everything I showed you so far has been that all changes in price and fraction of agency trades were attributed to surge in demand. So you might also, it would be possible to also think about that at least some of this rise in prices and is due to the increase in funding costs or other types of supply shocks. So what we do here, we can do, again, through the lens of our model, look at different scenarios. So what happens if the entire surge was due to supply shock, the green one, and what if the entire thing was due to demand shock, as I showed you earlier, or if we are somewhere in between. So we see the spike is lower if you have only supply shocks, but the profits would be elevated. So I'm running out of time, so I'm going to conclude. So I showed you that dealers absorbed no additional inventory in late March, became actually net sellers. The cost of providing these dealers that use trades that use dealer balance sheets surged a lot. And as a result, customers substitute to slower, less costly agency trades. Fed intervened, relaxed balance sheet costs and other constraints that dealers faced. Liquidity immediately improved for eligible bonds. And then later after these facilities were expanded for a wide variety of other bonds. So dealer bond inventories also surged. So we use a simple model to estimate the impact of shocks on consumer surplus and dealer profits. Thank you.
So we can move on to questions. I have about 8 minutes for questions. I can ask the first one maybe. Oh, go ahead.
Sorry, yeah, I just had a clarifying question. So I'm kind of unfamiliar with this method of agency, inferring agency trades. So, so you're using like consecutive customer to dealer trades to identify these things, right?
So there's actually a lot more detail in the paper. So we have a section that's dedicated in the paper to how we actually identify these like agency trades, but you can think about them. If you see a trade with the same exact size and within 15 minutes, this is likely to be an agency trade. They'll actually have other filters to pin down agency trades.
So I guess my question was, you said that those were slower. Is that something you actually document, that those are slower, or is that something just?
So we cannot document because we can in the data we don't have we don't know who customers are. We just have a flag for customers. It's really hard to figure out. Because as I said, the customer contacts a dealer looks for a match, and once the match is found, so then you see two trades in the consecutive, basically within 15 minutes in our method. So it's hard to say.
So you can't use like the time between the first match and the second match. That's not.
So we don't know when the customer actually contacted the dealer, right? There is no record of that.
Okay. So essentially, I guess what I'm saying is that it's sort of it seems like an implicit assumption that these are lower quality, slower trades, right? You really don't know that.
If you care about immediacy, which is you can argue is one part of liquidity is immediacy, then these are definitely taking a longer time to execute. So in that lens of caring about immediacy, then these are low quality trades. And this is like, again, this method is just like we're using literature by Feldhuter and others that they also use the same method. This is not something that we came up with. This has been used in the literature in many other papers.
So
can I ask a question? Oh,
sure.
Yeah.
Okay, so when you talk about dealer profits, I mean, we also were talking earlier that the shadow value of space in the dealer's balance sheet went up. So do you try to account for that, or?
We're agnostic about why the cost went up. So we're just saying, what if costs went up? Maybe there's risk, maybe there's like funding costs, maybe the balance sheet space went up. We're agnostic about why costs went up. So we're just like, this is like a very simple, obviously, model. This is not going to talk about like why the cost went up or why there's a demand shock. We just comparative static and looking at what happens if the demand goes up. So we don't have any micro foundation for the cost in the paper.
It's just a clarification. It's I mean, okay. So under the assumption of the model, so competitive pricing, then by the envelope theorem, you actually don't need to directly have direct measure of the cost. You recover the change in profit by using the formula given by the envelope theorem, and that accounts for both change in revenue and change in cost.
Okay, thanks.
Can I ask a question about so you constructed this dealer own inventory, which is kind of interesting. So it looks like it started picking up like, March 18, whatever, mid-March. So can you help me get the timing of the policy correct? So that's roughly when the Fed announced it would step in.
But yeah, the Fed announced the evening of March 17th, this PDCF. So then the 18th is the first day of trading after that.
Okay, but then they actually stepped in 2 months later, right, in May.
May 12th,
Yeah, the actual purchase happened later, definitely.
So
can I actually ask a question following up on that? Just how you think about the PDCF announcement versus when they can actually use it as a balance sheet? Just thinking about, can you differentiate? Sorry, I'm hopping in, but trying to just add to, I think, your question about, can you differentiate some of these?
Yeah, Anna, you just hijacked my question, but I give it to you. I mean, no, let me give it my spin. So, I mean, you have a quantity constraint. So how does the announcement on the quantity constraint have effects? I mean, that's one way to put it.
So one way I think about it, Ricardo, is that
this applies also to the SLR hypothesis, right?
Yeah. So one possibility. So I'm not sure we know the exact mechanism, but one possibility, right, is that it's as easy to find a buyer for some of these assets if these buyers know that if they need to sell it, that there's going to be a buyer of last resort at some point in the future, right? So you reduce a lot of uncertainty related to the assets. You can increase the price of the assets, things like that.
But that could work.
You could see the credit spreads of these things coming down as well.
That's
right?
fine, but that would mean that the market would otherwise, without the Fed stepping in, the market would have to believe that this is a very permanent shock. I mean, earlier we were thinking like this is a high frequency dislocation. So if the market thinks that, then the market should do it on its own. You don't need the promise of the Fed doing it. You know that somebody will take it later once the disruption's gone. You see what I'm saying?
So can I ask a question too? I'd be curious to see how these costs sort by size of the trades, especially the sales by the customers. Do you have anything on that?
So we have actually a table that we basically run our diff and diff, but only run it for 3 size buckets. So we look at micro trades, we look at large trades, and we look at in between 1 million and 100,000. And it looks like the majority of the improvement comes from these smaller trades and also larger trades. There's not a lot of impact on the trades between $1 million and 100,000. So it's in the paper, but I don't have it on the slides, I believe.
Okay, thanks.
Sure. Can I ask a question about this diagram? I was wondering if the initial selling of the corporate bond is related to what happened in the government bond market. So if I look at Darrell's slides about the timing where the spread in the government bond is hiking, that's when there's a lot of sales in the corporate bonds. Maybe the
that's kind of like a dash for cash
to relax, but balance sheet space for government bond.
Yeah, I mean, basically that's the idea of a dash for cash, right? You just like you're selling everything. You see even, I mean, treasuries are being sold, and there's like other papers that they show that even within corporate bond market, you sell stuff that are more liquid. For example,
no, I thought there's a supply shock. So then the dealer is trying to buy treasury bond through selling corporate bond. I don't know.
Oh.
I don't know. Because there was a huge supply shock during that period. I thought that foreign bond sellers trying to sell.
I see, I see. So you're saying they're trying to free up balance sheet space in order to be able to buy treasuries, right? This is kind of what you're arguing?
Yeah.
I don't know. I don't know. I don't have much to say about that.
All right, so let's move on to the second paper in this session. It's going to, Maureen, we're very happy to have Maureen O'Hara presenting Anatomy of a Liquidity Crisis, Corporate Bonds in the COVID-19 Crisis with Alex Zhou. Go ahead, Maureen, you have 20 minutes.
Let's see here. Can you see my screen?
Yep. Yeah, if you want to put in full screen.
Yep, I will do so.
Great.
I hope I'm going to do so. Hang on here. There we go. And you can see this, right?
We can't, it's still not on full screen. Oh.
It's not on full screen. Sorry. Hang on a minute.
I think if you make it full screen and then share it, I think that would work.
Okay. Let's see here. Is that working?
Yep, that's good.
You can see it now?
Yes.
Okay. Hang on. Let's see if I can get back to the beginning here. Sorry. This isn't working.
Try clicking on your slides, and then sometimes you have to activate your mouse.
Yeah, my mouse is working, but hang on, I'm sorry. Let's resume slideshow. Yeah, this is looking better. Yeah, that looks good. How are we doing? Have we got that?
Yep.
Okay, excellent. Sorry, everybody. And can you see me? I'm not sure. I can't see any of you, so we'll just have to wing this. Oh, there we go. I got everybody. All righty. Well, thank you very much. Let me, it's kind of fun being in a session where the two papers are actually going to be looking at the same sort of episode, but we're taking a slightly different approach. And we're going to see some of the same results, but I think it's going to be fun for you to see that we have a different data set. And so we can actually address some questions that the previous paper couldn't, and they chose to look at some questions that we chose not to. So anyway, should be kind of interesting. This paper is joint with my co-author, Alex Zhou. Alex on the call. And Alex is, of course, with the Federal Reserve, so we need to put up this very nice little disclaimer. So again, we've been talking about this whole thing, you know, for this entire conference. So the notion that things fall apart, I think, is really fundamental to what we're looking at in all these papers today. The fact that the corporate bond market faltered, I think, is really a very interesting aspect of this crisis. And it's the one that really attracted Alex and I because we've been very interested in the microstructure of bond markets. So as you begin to think about these issues, the fact that the bond market began to more or less stop functioning was, I think, quite intriguing. As you know, the Federal Reserve is going to try and respond with a variety of facilities. And again, we want to stress that, you know, this bond market crisis is part of a much broader set of crises, right? So we do need to keep that in mind. But I do think that what's particularly intriguing about this crisis is this is the first time that the Fed agreed to buy corporate bond and bond ETFs. And so we really do have a different scenario going on here. We're going to argue that a lens in which to look through this that's quite interesting is to think of the Fed acting as market maker of last resort. So a very interesting paper back in 2007 by Buter and Siebert, which the banking crowd sort of know about, may not be as well known to everybody on this call, but they made the argument that liquidity crises in kind of modern times manifest in different ways. You used to think of liquidity crises as being things that were bank driven. And but now we're really seeing liquidity crises that result in disorderly markets. And one of the arguments they make in their paper was that when you have these sorts of disorderly markets crises, you're looking at situations where there is no market maker with both the deep pockets or the knowledge to be willing to set bid and ask prices, and that becomes a huge problem. And their paper proposed that the Fed should act as market maker of last resort. We're going to suggest that that's a really interesting lens through which to look at what's going on here. And we'll try and suggest through the evidence we present that that really does seem to be a big part of the story of understanding at least part of what's going on here. So what are we going to do? One of the things we're going to be doing here is we're looking at essentially the microstructure of liquidity in the corporate bond markets. We're looking at trading, transactions, cost, liquidity provisions. So in that sense, we're certainly looking at similar questions, if you will, as our previous paper. But we have a slightly different approach because we actually have better data. So we have the regulatory trace data, which gives us, as our previous people had, you have the individual trades with size and time and all that, but we also have the dealer identities. And because of that, we can actually calculate for each dealer who's providing liquidity and their trading and their inventory. And so we actually know who's doing all this. And one of the interesting things to think about in this market, Darrell talked earlier about how in treasuries, everything goes through dealers. In bond market, corporate bond markets, that's been true, but we're beginning to see the rise of more electronic trading. A lot of that trading actually still goes through dealers because in a lot of electronic trading, it's still customer to dealer, they're just doing it on an electronic platform. But there's been a new variant emerged quite recently in the electronic platforms, and that's customer to customer trading. And so we also can sort out the customer to customer trades, and we're going to see what happened there. And then we're going to show how the Fed's actions via the PDCF and the SaMMF directly and indirectly affected liquidity. And we're going to be able to quantify this by looking at the actual transactions cost. So what are we going to find? Well, we're going to show you that in the crisis, trading actually shifts. It shifts to the liquid corporate bonds. And we're going to show that transactions cost triple before the Fed intervention. We're going to show that block trades are particularly affected here. So we do have analysis here done on trade sizes looking at what's going on. One of the most intriguing results, we think, is that transactions costs invert. That is, it's traditionally the case that bigger bond trades can trade more cheaply than little bond trades. That doesn't happen anymore. A very interesting result. We're also going to be able, because we know who the dealers are, we're going to be able to show you that the primary dealers and the non-primary dealers behave very differently. And we're going to show you that if you thought the electronic markets were going to be the solution to this problem, the answer is maybe, but the trading costs in the electronic customer-to-customer markets were prohibitive. And so really kind of fun results there. We're then going to show you some direct evidence on the Fed programs, the PDCF. We're going to show had an almost immediate effect on the primary dealers because we can sort out who they are. And we're going to argue that this, if you think back to my earlier quote from Buter and Silber, talking about dealers needing deep pockets, and they also needed to have some certainty about how to set the price because they're not sure what these things are worth. We're going to say that PDCF facts are really useful to think of in terms of addressing the funding problem because the PDCF is basically lending the money to the primary dealers, right? The SaMMF, we're going to show had almost immediate announcement effects and virtually no implementation effects. And that helps because during our period, they never did buy a bond. They eventually buy an ETF, but the actual buying in the SaMMF never really happens. But this makes sense if you think of it as the lender of last resort, as a backstop for corporate bonds addressing the one-sided market problem. So with that as a prelude, let me just make sure we're all on the same page. We're going to repeat what you've already seen. We're going to argue March 6th is when the corporate bond market falters. March 20th is when the primary dealer credit facility comes along. March 23rd is the announcement of the secondary market corporate credit facility. And again, the key thing to these things is these have particular requirements on who gets to be involved. So the PDCF is really, the Fed can make overnight or term loans to primary dealers on investment grade collateral that's eligible. And the SMCCF was also initially targeted for investment grade. And limited to investment grade bonds with maturities of 5 years or less. That will be expanded when you go to the SMCCF expansion on April 9th, which expanded the SMCCF to high yield bonds that were downgraded after March 22nd. These are the fallen angels, and high yield ITEFs, which is a real first. And then May 12th is when the SMCCF actually buys its first security, which is an ETF. So in our analysis, which is empirical, we're going to be looking at what we'll call the normal period, which we're going to call February 1 through March 5th. We're going to look at the crisis period, which is March 6th to the 19th. And then we're going to have this regulation period, which we'll have from March 20th to March 19th. So we're going to be able to look at kind of before, during, after a little bit and give us some real understanding, I think, of this microstructure. Now we're going to measure transactions cost differently than the previous paper, right? Because we have every trade and we're going to be looking at measuring the price impact. And this is kind of a way you prefer to do it because you can control for things like the trade size. You can control for dealer identity. You can control for the sorts of things that we know affect transactions costs. So if you have the data to be able to do this, it's very useful. The benchmark price we're going to use is the prior trade in the bond in the inter-dealer market. So again, to compare and contrast with the paper before, they were using sort of the volume-weighted average price over the day. But we're actually doing this on a trade-by-trade basis because, again, we're interested in slightly different questions. We're kind of interested in this anatomy of the crisis, looking at the microstructure impacts. So here's a picture that I think is kind of fun. I tried to think a little bit about pictures that might differ from what you would have seen in 3 previous papers. So here I've broken it down into the transactions costs in investment grade and high yield bonds. And again, the results here, similar to what we've seen, bad things happen to transactions costs. And you can see here, this is roughly March 6th, which is where we start calling the crisis period, because until then it's kind of bouncing around. But when you get here, it's not bouncing around anymore, it's just going up. And so this is the investment grade bonds, and these are the high yield bonds. And obviously what's intriguing is both are going up, but in many ways, investment grade is deteriorating big time here. And when you see, here's the PDCF launch, what you see is a big gap develop now, right? The investment grade has what looks like an immediate effect. And the high yield, there's a gap that comes up, and that gap remains. So if you look back here, it was much smaller than it is. And we can talk a little bit at the end if we have time about where things are now. Just to quantify what we're looking at, sort of just in averages, if you put these two together, the average transaction fee in the sort of prior in the normal period was around 40 bips. When you get out to the crisis, it's 90 bips. So we're taking every trade here and we figure it all out in terms of every trade and every transactions cost. So we do get significant and obvious increases in the transactions costs. Here's the trading cost inversion, which I think is really interesting, at least it is to us. So what we have here, these are the different trade sizes. And so one of the things you see here, here's retail trades, and here's the odd lots, and here's the round lots. So the round lots are sort of this line. And then you have the block trades. And so usually you know, block trades were usually the cheapest of the bunch. You begin to see odd lots. This is reflecting kind of the rise of the electronic systems where a lot of these odd lots trade. But, you know, traditionally, block trades could trade a lot cheaper than the retail. But look what happens. The block trade prices go through the ceiling. And you can, from the perspective of the market, I mean, this is kind of hitting at the heart, because the fraction of trades that are block trades in these markets is, we have another paper where we look at this, and I think the block trades are 70% or more of all the trades. So huge impacts here. This inversion is fascinating. I mean, I have not seen this before in the bond markets, and it stays that way out here. So very interesting microstructure impacts here going on in this crisis. So one thing to think about is which bonds actually traded. And here we get some interesting results. I'm going to go through this quickly because I know we don't have massive amounts of time. There's only 3 results here on this page. That during the normal period, more liquid bonds essentially trade more and at cheaper costs, right? During the crisis, more heavily traded bonds here have higher trading costs. So what you're seeing here is that bonds that are trading heavily, their trading costs are going up, and those are the most liquid bonds. So it's really kind of interesting that more liquid bonds during the normal period trade more during the crisis. So we see a big shift during this crisis period. You start seeing, you know, in the normal period, the difference is now, I think, a large part of what we're seeing is, you saw the mutual fund data that Darrell talked about, or perhaps our previous authors. The bond mutual funds are hemorrhaging, right? And so they're selling bonds, and they're selling the most liquid bonds first. And that seems to be spreading throughout. And so the types of bonds that are trading during this crisis are changing. So let's think about what lies beneath. So we want to consider these factors influencing the supply of corporate bond liquidity. And we're going to look here at dealer behavior, customer trading, and Fed interventions. So again, this is similar to the paper that the picture you saw before about dealer inventory changes. So again, one of the things you see, yeah, these are the sort of cumulative dealer trading. And again, you know, their inventories are going down, and it is fairly dramatic. What I think is kind of fun to look at, dealer inventories way out here are far above the levels that they were in February. So from an inventory perspective, things really did kind of get better by about here. What's intriguing to think about is looking at the difference between the primary dealers and the other dealers. So here we're looking at sort of their cumulative inventory changes. And one of the things you see is they are selling. Mostly it's the non-primary dealers are selling. So there are 24 primary dealers. In the first quarter, there were 600 dealers who made markets in corporate bonds. So the primary dealers are the bulk. I mean, I think Alex can help me later if I get this number wrong, but I think they do about 70 to 80% of the volume. But nonetheless, there are a lot of dealers. One of the interesting things that we found that we didn't expect to find is the number of dealers trading over the crisis period is actually fairly constant. You don't have dealers leaving, which I expected to find. But you do see a big difference in the behavior of the primary and the other dealers. And notice that when the PDCF comes in, the primary dealers immediately start building up their inventories again. They stop selling. The other guys don't. And it makes sense because the other guys actually aren't affected by the PDCF because it's only for primary dealers. When the SaMMF comes along, you begin to see changes in the other guys. And then the process continues here. So let's figure out what affects dealer inventory changes. So what we're looking at here is we're going to explain the inventory change by a variety of variables here. We'll have the crisis, the regulation period, crisis period, the expansion, the implementation, and then we're going to actually do triple differences here to try and sort this all out. So what's the long and short here? During the crisis period, dealer inventories fall. All right, so there's no question about it. This is average dealer's inventory is falling 1.835 million. During the regulatory period, it bounces back up. So you can see it's coming back up nicely. But it's not just everybody. You've got to look at for who does it matter. So we're going to look at here, we're going to do triple differences. We're going to look at trades, the inventory effects for investment grade by prime dealer after the regulation. We're looking at 2 weeks after the regulation period here. And what you see is that basically after the regulation, which is this after March 20th, the dealer 2 weeks after the PDCF, prime dealers have increased their net buying by 20 million. So we're seeing immediate impacts of, or pretty quickly, of these changes.
Maureen, you have about a minute left.
A minute. Ah, excellent. Well, this would have been a really neat thing to talk about too. We were showing here, are they linked? The answer is yes. We can show that the dealer's inventories are directly affect the transactions costs. So, and let me move to the customer-to-customer trades because we aren't going to be able to talk about those very much. Here's the customer-to-customer share. So we actually are looking at customer-to-customer trades that are taking place in electronic venues. Here you can see the volume down here goes up, but it's still minuscule. This is the percent of the daily trading volume. It's tiny. So don't count on these guys to bail you out. And here's the transactions costs, right? So these are the customer-to-customer trades. These are the customer-to-dealer trades. These things are prohibitively expensive. They're twice as expensive. Here they were essentially down here when we started. These customer-to-customer trades were 24 basis points. These are 165 basis points. We are sort of near the end, so let's talk a little bit about the effects of these things. What we're going to find here is the PDCF effects, and we can talk about these exactly. As we think about these PDCF effects, what we're seeing is big changes. So here what you see is we're going to look right around the eligible collateral, and we're also going to look at the difference between high yield and investment grade. And we're going to do, again, these triple differences. And here, we're looking at transactions costs, and you see that the effect for investment grade primary dealer and regulation for the PDCF, we estimate to be these 10 basis points, 16 basis points if we just look around the cutoff. This is the difference between investment grade and non-investment grade. These guys aren't eligible, these guys are. If we look at the SaMMF effects, here you're talking about long-term and short-term. Again, these are the direct effects that we attribute to the SaMMF. So these are the direct effects to the PDCF. These are the direct effects to the SaMMF. And here again, we split. These guys are eligible, these guys are not. You can see that there's an additional 21 basis point reduction that occurs due to the SaMMF for the eligible bonds. So I've gone through that awfully quickly. Let me get to the conclusions. I think the key thing to think about is, I think our results really do support the idea of the Fed acting as a market maker of last resort. And I think that the fact that these SaMMF effects are strictly a liquidity, are an announcement effect and not an actual buying effect is very much consistent with that. The PDCF actually gives the money, they're funding. That's part of this. But being willing to buy seems to have dramatically changed things, just the willingness to do it. And so what we find here is that trading changed, dealer behavior changed. Primary dealers play a mostly positive role. They do start selling, but not as much as the other guys, and they immediately change when they apparently can fund. We saw the electronic CDC trades are also provably expensive. And we showed how the Fed intervention contributed to easing the crisis. So let me land on this slide because I think one of the things that's really interesting to think about, corporate bond liquidity is not yet back to pre-crisis levels. So there are interesting challenges here when we start thinking about these markets. Is market maker of last resort a new direction for central banking? Well, remember the Fed's, secondary corporate, financing facility is not like what the European Central Bank is doing, where they're using bond and ETF purchases as part of quantitative easing. So far, the Fed's purchases have been fairly limited. And if you think of being a market maker of last resort, maybe you don't have to buy anything at all. And maybe that's a good thing, because we do know that the Fed's purchases ultimately, were they to do a lot, will have effects in the markets. And there's a very interesting question about what those effects are and whether you'd like them. We'll leave that as a great topic for future research. Thank you.
Okay, thanks, Maureen. We'll open up to questions.
So can you unmute Alex? Because if there are any hard questions, I'm going to dump them all on Alex.
Okay.
I have perhaps a quick question about the effect of the PDCF.
Mm-hmm.
So the graph you show are about net trade with customers, but do you see after the PDCF that the non-primary dealer, for instance, sell to the primary dealers? Do you see patterns of inter-dealer trade that are consistent with credit constraint being relaxed for one category but not the other?
That's interesting. Alex, did we look at that? I don't think so.
So no, what we look at the paper is mainly the trades between dealers and customers. So what you are referring to are the inter-dealer trades. That is actually a very good question. We could definitely look at inter-dealer trades to see how they trade with each other, because we have sort of identities on both sides of the trades for inter-dealer trades.
Mm-hmm.
Maureen, could I ask a question?
Sure.
I typed this up in the chat, but since you have the dealer data, you said that the number of dealers remain constant throughout this episode. But
Active dealers. Yeah.
Active dealers. But do you see any difference in the concentration of volume across dealers? So in other words, is there any evidence of sort of increased market power among certain dealers?
We haven't looked at that yet, but yeah, I think that we can check that. I can get back to you.
Okay, because we were sort of curious of that when you see these large increase in spreads. We were worried if that was maybe playing some role or not.
Yeah, I had thought that we'd see a lot of the dealers just dropping out. And yet the number of active dealers was almost constant over this period, which was really remarkable in my view.
Yeah.
So with respect to the electronic customer-to-customer market, is it possible that they substituted and reverted to like relationship trading with the dealers?
I'm not entirely sure. I mean, the customer-to-customer markets, the all-to-all markets, you have, usually the way they work is they send out this request, for I want to trade. And dealers can trade with you if they want, if they're part of this trading platform, like so market access. Their customers are both customers and dealers, and a lot of the trade that takes place on these electronic platforms are between the customers and the dealers. They may be done electronically, but they're still customer to dealer. What we focused on were when the customers traded directly with the customers. And so, did the customers move back and forth from the dealers? Well, you'd have to be desperate to try and trade at the trading prices that we found in the customer-to-customer markets, I think. Alex, do you have a thought on that?
Yeah, so for different for electronic trading platforms, different platforms use different protocols to execute their trades. But oftentimes this RFQ and all-to-all sort of coexist. So if you see sort of customer-to-customer trade in the trace tape, that basically means that the buy side actually win the trade from the dealer community. So they're providing better terms, or dealers are just not willing to trade.
Mm-hmm. Yeah, the electronic markets are interesting because when you're trading this way, you will potentially get back, 10 different, people 10 different clients willing to trade with you, right? And typically what Alex and I have found in other work is the dealers win. But here you're seeing what happens when the customers win, and it's not pretty.
All right, so I think we're gonna move on to a 10-minute break. Feel free to stay on this Zoom call and chat further if you want, but otherwise we'll meet back at 2:20. Thanks, Maureen.
You're welcome, thank you.
There's a question from the audience, Maureen, if you would like to take it. David Boogers is saying, question about a potential mandate for the Fed as a market maker of last resort for corporate credit. Is there a view on the optimal liquidity for corporate credit markets? Lots of practitioners opine that the more liquidity isn't always better, especially in credit markets.
Well, there's been no question, and Alex, we have different views on this, but ever since the Fed basically announced this SC, FF financing facility, the credit markets went nuts in terms of new issuances. It's been huge. And, is that due to the Fed's new role? Well, it certainly seems like it might be. To the extent, if the Fed is going to step in, and in a sense, almost provide like the Greenspan put underneath the bond markets, then not surprisingly, you're seeing a lot of corporate issuance. And is that a good thing or a bad thing? That I think is a very interesting question. And both Alex and I have concerns about how this Fed thing will change the composition, because my understanding there's been a tremendous amount of high yield issuance too. But Alex, you're more involved in this. Your thoughts on that?
So I'm speaking for myself, not for the Fed, and I totally agree with what you just said. There has been sort of a lot of concerns on, the potential distortions that these credit facilities could cause to the markets, including sort of the allocations of the credit across firms. But I think it's just too soon to draw any conclusions.
Yeah.
I think this kind of I'm always thinking about it. When you say market maker of last resort, do you mean something like Diamond did a type of story that we are gonna just help people to coordinate in a good equilibrium? But if the question is, well, maybe we're distorting some incentives, then it's not just a coordination device, right? So it's really affecting decisions.
No, I mean, with the Fed being willing to add these as assets, I think there's no question that this is going to have allocation effects. But I do think the fact that they're willing to buy ETFs this time, because the ETF market was in, such stress at the time, very, very interesting. And the fact that, you see the big impact when they haven't actually done anything is, to me, really interesting. It really strikes me that it suggests, we're not going to let these markets be disorderly. We are going to be willing to step in ourselves if we have to. That sounds like a market maker type of function to me.
Maureen, just to kind of follow up on that, this is Simon.
Yeah, Vish, did you have or who was it who wanted to follow up?
This was Asani.
Oh, hi, Asani. How are you?
Hi, Maureen. Good to see you. I was wondering, so it seems that it's pretty difficult to kind of draw a channel by which sort of, the Fed announcements, affect dealer-specific inventory or balance sheet, right? Because since there was really no actual purchase. So to me, it seems more likely to sort of more like a general market effect.
Maybe, but what about a risk management effect? I'm a dealer, right?
Yeah.
How much am I willing to hold if I'm not sure what's going to happen in these markets? If the Fed steps in and basically says, don't worry about it, we're going to be there, and these things, if need be, we're going to buy them. As a dealer, from a risk management perspective, these just got a heck of a lot less risky for me.
Right. So actually, I would think that as a sort of broad market effect, right? because dealers have value at risk limits. And if the Fed does something, it doesn't even have to be corporate, but whatever action it takes, it eases market funding conditions, just market conditions more generally, then that would relax the VAR constraint. So I think that's a kind of a different mechanism than what I think of as a market maker of last resort.
Maybe. I mean, we just found it interesting to relate it to the notion, and you will see practitioners talking about this. They saw the Fed as having a similar sort of role, and so, it's an interesting question. It is the case that they're playing a different role, and I think what's interesting is they didn't promise how much they were going to buy, right? So this isn't a QE thing, right?
Right, exactly.
So,
I mean, that's interesting, right?
I guess kind of jumping in, I think this came up in a lot of the chats. There's a between the Fed targeting short-run liquidity and the Fed targeting expectations. And what you're kind of saying is the Fed is targeting expectations. We're going to come in the market and reduce the volatility, and consequently, this asset class is going to be less risky than you think it is.
Yeah.
And I think one of the queries, and I don't know that's possible, is can we disentangle that effect, which is a forward-looking expectations effect, from a more traditional short-run, I relaxed your inventory constraint by giving you more money at a cheap rate. Is there a way to kind of disentangle these two effects?
Well, we did that kind of in the paper. I mean, Alex, you can jump in here, but we actually try to disentangle exactly how much did the PDCF affect the transactions cost, and exactly how much did the SCCFF. I can never get all these initials right. Alex, you want to build on that?
Right. So the PDCF is more directly targeted at improving sort of dealers' funding conditions, and the credit extended through PDCF was offered to primary dealers. So in the last sort of the test that Maureen just presented, we sort of focused on this triple difference, right? It is the investment grade collateral for primary dealers after the implementation of the PDCF. And we showed that the effect is more for primary dealers. Now, unfortunately, the SaMMF is sort of announced at a similar time, so it makes the disentangling the effects of these two facilities challenging. But the SaMMF sort of focus on the short-term bonds. So if we actually zoom in on this on a small set of the bonds with time to maturities right around the 5-year cutoff, and we see there is a difference between these two types of the bonds. I think that if you look at sort of the timelines of the Fed actions, especially in the Treasury market, you could see that this was the Fed sort of started by trying to boost the liquidity provisions by starting upsizing their repo operations first, and it didn't really work that well, and that's why Fed jumped in and sort of increased the direct purchase of the treasuries. For the corporate bond market, all the actions happen slightly later, and then they're all sort of at the same time. So that's why we sort of trying to use this triple difference design to disentangle the funding or the liquidity provision story versus the dealer's willingness to provide liquidity story.
Yeah, I think like you said, it's challenging, right? Because there's basically like this super short lag between the two facilities.
Yeah.
Can I ask a question to what Maureen just said regarding the risk management? So there are probably two types of risk management. One like managed at the dealer itself. The other is more like a constraints, right? So like the bank holding company, because of the regulation, they probably need to put a limit of the risk they take. So in your experience, do you say like both of them are playing a role, or like which one is kind of playing a bigger role in practice?
I don't know. Alex, do you have any thought on that? I mean, we didn't.
No, I don't know the answer to the question. Yeah.
I don't know. I don't know if we have the data to do that. You know, yeah, that would be, I mean, it might be a very interesting paper here, taking, you know, what you know about each dealer and then, you know, relating it back to the bank holding company and all that. But that would be another paper, and we didn't write that one.
I think Zhaogang and I have a paper on agency MBS. We did a little bit of that. So we track like which dealer belonged to bank holding company subject to LCR.
Yeah, that'd be
we compared those dealers with the dealers that were not, and we found that the dealers that were providing more liquidity were the ones which were affiliated to the LCR banks.
Hassani, I'm sorry to interrupt you, but if it's all right with you all, I would like to continue. We need to continue this session.
Oh yeah, sure. Yeah.
Thank you, and I'm sorry about that. Anyway, thanks for coming back. I hope you all enjoyed the coffee break. We're excited to have Lina Boyarchenko presenting next.
Great. So let me share my screen. Okay. So can you all see my slides?
Looks good.
Okay, great, thanks. So I'm going to present another paper looking at the corporate credit facilities. And this is joint work with my colleagues Anna Kovner and Shachar. We're all at the Federal Reserve Bank of New York. So the Federal Reserve disclaimer applies that these are our views and not the views of the bank or of the reserve system. So I'm not going to spend a lot of time talking about the corporate credit facilities themselves, given that we've seen two papers already that talk about them. What I do want to highlight is that these facilities are meant to be liquidity facilities that were established to ensure access to debt markets for US issuers in response to the dislocations we saw at the beginning of March. And the approach of the facilities is two-pronged. So we do have the secondary market facility that the previous two papers focused about, but of course we also have the primary facility, which is supposed to act on the primary market directly. And so the big picture question we are going to look at in this paper is, broadly speaking, how do the corporate credit facilities work? And in particular, what can we learn about the way that the corporate bond market works in the process? And again, just to set the stage, and this is going to echo very closely what we have already seen in the session. So if we look at both credit spreads on the left-hand side and effective bid-ask spreads on the right-hand side, we see a dramatic increase in both ahead of the CCF announcement on March 22nd, then a normalization over time with a faster normalization for securities that are eligible for direct purchases for a facility, by the facility, excuse me, and a slower improvement in spreads and other securities, and again, both in credit spreads terms as well as the bid-ask spread terms. So what we're going to actually do in this paper is think about the impact of both the announcements and the purchases that were conducted later on different aspects of this market. So we're going to look at both secondary market functioning, again, both in spread and liquidity terms, primary market functioning, also both in spread and quantity terms, and finally, we're going to take a quick look at how the intermediation worked, again, thinking about both the primary and the secondary market. Because again, as a reminder, the main purpose of these facilities was to actually get credit flowing to the US corporates in the primary market more so than necessarily improving conditions in the secondary market for its own sake. Before I get into the details, just a reminder of some key dates and eligibility criteria for these facilities. So as we've discussed before, on March 22nd, the corporate credit facilities were announced. And on the initial term sheet for the primary market facility, the eligibility criteria were up to 4-year maturity of the newly issued bonds, bonds issued by non-banks, investment grade rated and issued by issuers with the majority of their operations in the US. For the SaMMF, the restrictions were fairly similar, except that the maturity restriction was up to 5 years, and there wasn't this focus on US operations. On April 9th was the first term sheet update, which expanded eligibility of securities to the so-called fallen angel issuers, as well as to high yield ETFs. On May 12th, the facility began its purchases, and in particular, it began the ETF purchases on that date. Cash bond purchases commenced on June 16th, and finally on June 29th, the primary facility became active, even though as of this date, there hasn't been a bond bought through the primary facility. In terms of what we're going to look at, it's helpful to think about the facility through potential mechanisms. So one effect that the facility may have had is to just reduce tail risk for the economy as a whole. This sort of goes back to the buyer of last resort idea. In terms of the facility providing, reducing tail risk for the economy as a whole, you would expect to see a uniform improvements in conditions across all issuers because you're reducing tail risks for everybody. A alternative mechanism, which I should highlight that none of these are mutually exclusive necessarily, is that facilities reduce indiscriminate asset sales by investors. Why? Well, again, by their existence, they're going to decrease investors' incentives to acquire information about securities. And in the Gorton view of information-sensitive securities, that should suggest that you will see biggest improvements for what normally would be the safest issues. Finally, the facilities may alleviate intermediary balance sheet constraints, and in which case we should see biggest improvements for issues that require more intermediation. So in case I don't get through all of my slides, just to give you a preview of where we're going. So we are going to find evidence that is consistent with all of these mechanisms. So first, if we just look at the effect of the announcement, we see that in the secondary market, the initial announcements account for roughly a third of the 140 basis point improvement in credit spreads that we see between March 22nd and June 26th for the average bond, and around half of the 200 basis point improvement in bid-ask spreads over the same period. We do find that conditions for facility eligible bonds normalize quicker. And once we start looking at purchases, we see that cash bond purchases have a bigger impact than ETF purchases, especially when we look at the effect of the facility purchases for bond liquidity as opposed to bond spreads. Turning to the primary market, facilities have an immediate impact on the primary market, restarting issuance in the primary market without distorting either issuance decisions, and I'll talk later about exactly what we mean by that, as well as relative primary market pricing. And finally, the buyer of last resort nature of the facility is conducive to more active participation of large dealers in both the primary and the secondary market. And again, I will explain later what we mean by large dealers in this context. Okay, so let's start with the secondary market. So we're going to, again, use
Nina, can I ask you a quick question? It's very simple. It's just, when the announcement that they're going to buy is made, is there any mention about the price?
No.
No. Okay. Okay. Thank you.
We're going to be using the same regulatory trace data that Maureen was talking about, and we're going to focus on bond level changes in prices, liquidity, and liquidity provision. Today, in the interest of time, I'm going to start by just showing you the results for credit spreads and bid-ask spreads, and I would direct you to the paper for the other measures of price changes and liquidity. And so we're going to look at these bond level changes, controlling for characteristics. And in that sense, we can think about the constant that we estimate as the average effect on the market, the coefficients on characteristics of eligibility as measuring the differential impact on eligible security. And finally, once we start looking at the effect of the purchase volume, then of course the coefficients on the purchase volume are going to help us think about the differential purchase versus announcements effect. So if we start with the announcement effect, the regression that we're going to run is at the top of the slide. So here M is our acronym for a measure of secondary market conditions. So again, I'm going to show you results for duration match spreads and effective bid-ask spreads. And we're going to think of these quantities as the cumulative change relative to March 22nd worst for that particular bond. We're going to estimate this regression as a repeated panel for each trading day, and we're going to relate this cumulative change to the bank issuer dummy, so meaning is the bond issued by a bank or not, as well as to a dummy indicating whether the bond is scheduled to mature before September 2025, and finally an indicator for whether the bond is investment grade or fallen angel versus a high yield. We also include all the other usual bond characteristics that the literature has found to be informative about credit spreads and bid-ask spreads, but we don't report those coefficients. Now in the paper, we have additional results that I'm not going to show you, but for example, we show that you can run this regression even controlling for issuer fixed effects. And the results I'm going to show you are going to hold controlling for this within issuer variation, as well as you can look at issuers in different types of industries, and we're going to find that the biggest effect is going to be in the industries that have lost the most employees relative to the start of the year. So if we start by looking at duration match spread, on the left-hand side, I'm showing you the average effect, so the estimated constant. On the right-hand side, I'm showing you the coefficient on the high yield dummy. So if we first focus on the average effect, we see that, as I mentioned before, overall, there has been roughly 140 basis points of improvement, with about a third of that happening in the first week, so the week ending on March 27th. Then a further third happened between that March 27th date and the April 9th announcement. And finally, the last third of that effect only actually happens once the facility starts buying corporate bonds. If we look at the high yield dummy, we see that the spreads of lower credit quality bonds take longer to respond. And indeed, the spreads on the lowest quality corporate bonds have still not fully normalized back to where they were at the beginning of the year. In the paper, we show that if you run the same type of specification for default adjusted spreads, you actually see a bigger improvement on average in numbers terms, which suggests that a lot of the retracement that we see in credit spreads is actually due to a decline in risk aversion. If we do the same thing, looking at effective bid-ask spreads, again, roughly 200 basis point improvement on average between March 22nd and June 26th. 100 basis points of that happens in the first week, a further 60 by April 9th. And then that last 40 basis points only really happens once the facility starts buying actually the cash bonds, so not after the commencement of ETF purchases. And again, as with the credit spreads that we've seen, there has been a slower improvement in the liquidity of lower rated bonds, although unlike the credit spreads, the bid-ask spreads for lower credit bonds are now almost back to where they were at the beginning of the year. Okay, so I've given you a little bit of the flavor of where the purchases made by the facility come in. We can actually look at this again from a regression standpoint, and the way that we're going to do that is by looking at, again, the cumulative change in each of these measures as a function of the volume bought by the facility. Here, we're going to decompose the ETF purchases into the implied purchases of the individual bonds that the ETFs hold. We're going to make different bonds comparable to each other. We're going to standardize the volume and think about this standardized purchase volume as by the end of the sample, the standard deviation is roughly 1 billion. So we're going to, again, we're going to estimate this as a repeated pattern for each trading day. Again, in the paper, we show that you can run the same specification with issuer fixed effect. You may wonder as I go through these results whether this is about purchases or purchase eligibility. In the paper, we show that you can actually look at what happens to bonds held by ETFs that are not, that wouldn't otherwise be eligible for direct purchases by the facility. And you actually, unlike the results I'm going to show you, is that you see a smaller differential effect of eligibility. So this really is something about the purchases themselves rather than looking at purchase eligible securities. So starting with the credit spreads again, so we see that the cumulative purchases do have a significant effect on the credit spreads narrowing for the average bond over and above what over and above what an average bond has seen in the improvement that wasn't bought by the facility. And the way to think about it is that roughly a 1 standard deviation more of purchases by the end of the sample corresponds roughly to an additional 25 basis points of spread decrease. And again, as we see that there is an acceleration in this estimated effect after the commencement of cash bond purchases on June 16th, we see that the cash bond purchases have a bigger impact than ETF purchases, perhaps not surprisingly. Turning to the bid-ask spreads, you will see that there is almost no differential effect of the ETF purchases. There are a couple of different reasons why that may be happening. One is, of course, buying ETFs is not the same as, is not necessarily the same as creating bond demand, because, for example, if dealers had built up a lot of ETF inventory ahead of the facility actually buying the ETFs, they wouldn't need to create new ETF shares by buying the underlying basket. Now, instead, if we actually look at the effect of the cash bond purchases themselves, we do find a sizable effect. Roughly for every 1 million of cash bonds bought, we get an extra 2.5 basis points decrease in bid-ask spreads over the sample. Okay, so what about the primary market? The whole purpose of these facilities was to create a primary market, was to restart the primary market demand. We're going to look at this from a year-to-date trends perspective in prices measured as spreads to nearest maturity treasuries, issuance volumes, and underwriting activities across issuer categories. So starting with the quantity of issuance, facilities have restarted issuance across different types of issuers, so both across different credit ratings, across maturities, across bank versus non-bank, et cetera, et cetera. So one thing that I do want to highlight here is that we do see a similar acceleration of issuance pace across maturities. So it's not that issuers are only able to issue bonds that will be eligible for purchases by the facilities, and instead they're issuing both below the 5-year threshold as well as the above the 5-year threshold. If we look at the relative prices across the across issuers, again, we do see, of course, that the primary market spreads rose in March, but have mostly retraced their increases since. And in particular, we do still see that primary market spreads for investment grade issuers continue to be below the spreads for the high yield issuers, meaning that the existence of the facility doesn't seem to be distorting relative primary market pricing across riskiness of issuers. In the last few minutes that I have, I want to go back to this question of intermediation.
I'm sorry, Nina, actually you're officially out of time, so it would be nice if you could wrap up and then we'll take questions from the audience, please.
Okay, I can go to my to my conclusion slide. So, okay, so just to summarize, we document a significant impact of the CCF announcement on bond spreads and liquidity, both in the primary and secondary market. So this is consistent with this view that the facilities reduced overall risk in the economy. We do find a bigger effect of cash bond purchases than ETF purchases on the secondary market, which is consistent with sellers fulfilling facility ETF purchases from inventory rather than by buying the underlying baskets. The impact on prices is differentially larger for eligible issuers, while the impact on liquidity is somewhat more widespread. So this is consistent with the information sensitivity hypothesis of people no longer having to actually acquire information about safer assets. And finally, what I didn't get to show you is that the announcement increases intermediation by large dealers, which is very consistent with the buyer of last resort nature of the facility. And
thank you so much, Nina. Is it okay with you if we go to our first question from the audience, from Stefania D'Amico?
Yep.
Okay, Stefania, please unmute yourself and ask.
Can you hear me?
Yes.
Hi, Nina. I found the paper really interesting. I wanted to ask you two questions. In the first type of regression, before introducing the quantity purchase, I couldn't understand the identification methodology over a period of more than 100 days. So I could understand how to make sure that those dummies over such a long time period are capturing only the effect of the credit facility, because I can imagine the maturity dummy or the high yield dummy or the bank dummy to capture other effects over the course of this period. And then I wanted to ask you, when you introduce the quantity purchase, since the Fed indicated in the Q&A that the pace of purchase depends on various measures of market functioning, including spreads and bid-ask. In particular, they said that they may even pause the purchases if market functioning improves a lot, or they might restart the purchases if market functioning deteriorates. So it is possible that the pace of purchase is responding to spread and bid-ask. So I wasn't sure how the methodology control for the endogeneity between bid-ask spread or credit risk and the quantity purchase.
Thanks, Stefania. So I'm going to take these in the reverse order. So first, in terms of endogeneity between purchases and spreads, It is true that the overall pace of purchases is related to overall market conditions. This is why it's extremely important to do this analysis at the bond level. Because at the individual bond level, the purchases of an individual bond are not guided by spreads in that bond or bid-ask spreads in that bond. So it's absolutely crucial, we think, to do this analysis at the bond level and not at the aggregate market level. And we would argue that this is true actually for both the announcement effects that we document as well as for the purchase effect. Now, in terms of where is the identification coming from, again, this is more of thinking about the overall path of the improvement. We know that, of course, the facilities announcement on March 22nd was not the only thing that has happened over this time period. But again, this is why we're giving you the full path of the estimates, not just estimates 100 days since. And the other thing that I would highlight is that once you actually start controlling for things like issuer fixed effects, a lot of these things about, oh, have the conditions, is this picking up something, some other announcements get negated, because we are in those specifications talking about bonds of the same issuer that are below 5 years or above 5 years, or bonds of the same issuer that are rated high yield or rated investment grade.
Thank you. Yeah, if you have questions, please ask them. Fire away. Well, if there aren't questions, Nina, then I apologize that I cut short your slides. If you'd like to talk about the last 2 slides now, you still have 4 minutes.
No, I think it's okay.
Nina, sorry, can I ask you, but why do you think that the Fed cannot target particular bonds that are particularly liquid?
So couple of things. One is, of course, when the facility buys ETFs, by definition, it's not targeting any particular bonds. In terms of what the Fed buys in the cash bond purchases, if you look at the public reporting, you will see that the idea is to buy a broad market index rather than targeting any individual bond.
Maybe I'll just expand also on what Nina said to the conversation we were having previously about ways in which we think these types of interventions can distort markets. I think that I would be interesting to have a discussion among this group as to the optimal ways to develop a program to support market functioning without allocating credit. So you can think of this targeting of a broad market index as one of the ways to reduce doing that. That is also communicable to the public.
For example, in the broad market index, right, the weight in the index are percentage of amount outstanding. And we know the issuance, as you show, responds very fast. So the amount outstanding itself of each bond is changing. And therefore, since the New York Fed update the percentage every 4 to 5 weeks,
so actually the new issuance is not concentrated in the below 5 year as the bonds that the Fed is targeting, but the issuance is actually done surprisingly for bonds that are not necessarily would be considered eligible for us to purchase. So that's.
But you don't need it to be concentrated in the less than 5, you just need it to increase. So if issuance in general is increasing over the same period in which you're doing the purchase, over these 100 days, right? The weight are just to the outstanding, and so is practically a mechanical way in which the index is responding to the outstanding, and therefore the part purchase distribution, by replicating the issuance pattern, is responding to issuance.
The amount outstanding, again, of the index of the bonds that are eligible to be included in the broad market index are the ones that US companies below 5 years. As you would see, there is not a lot of new issuance done in that category.
Isn't it, Stefania, another way of...
The assertion that the amount outstanding is increasing as we go in the other days, that's not aligned with what we observe in the market.
So, I mean, a couple of other things, Stefania. So first, when we look at changes in spreads, since most of our analysis is about changes in spreads relative to March 22nd for that particular bond, that by definition is not picking up the new issuance, right? Because the new issuance did not have a spread as of March 22nd. The other thing with respect to the broad market index is, I think if your concern was about the amount outstanding weights was a big issue, you would see the number of bonds eligible for the index increasing over time, and I don't think we have seen that.
Thank you so much, Nina, for the presentation, and Stefania for the discussion. Well, it's high time we have Tyler present his work.
Okay. Oops. All right, so thanks a lot. Good, full screen. Okay, good. Thanks so much for...
sorry, Tyler, we can't see the slides.
You can't?
No.
Okay.
So Tyler, you want to do full screen first and then share if you're using a Mac. That's usually...
I see. Full screen first and then share. Okay.
Yeah.
Sorry, I should know this as the moderator, but I actually don't. Looks perfect.
Better?
Yep,
okay, good. Sorry, thank you, Mahyar. Okay, so this is joint work with Alan Moreira and Valentin, and let me just jump right into it since I spent 2 minutes on sharing my screen. We're going to be after a lot of the same questions as some of the previous papers, so I'll skip over some of the initial facts a little bit more quickly since I think we're on the same page of those. So I want to start with the cumulative returns across a few different assets during the COVID-19 crisis. Here, the one that we're going to focus on is the blue line, which is investment grade corporate bonds. You can see the first 3 weeks of March, the cumulative return there is minus 20%, so a really dramatic decline in investment grade corporate bond prices on the same order of magnitude as high yield and as the same order of magnitude as the stock market over that same period. So really dramatic decline. That's surprising in part because usually the safer end of the credit spectrum is less sensitive initially to downturns. So a really simplistic approach would be based on the pre-crisis beta on the stock market for investment grade bonds, you would expect to see a decline more like 5% versus a 20%. Okay, so this paper is going to be after why this happened and what is behind these price movements. Okay, so we're going to try to make progress on that, and we're going to show you a number of more nuanced observations to try to get at that. So what we find is a pervasive pattern of dislocation in debt prices, particularly investment grade debt. And what I'm going to show you is that during this decline, more capital intensive bonds trade at a discount to CDS, and typically more liquid ETFs also trade at a discount relative to the underlying bonds. Both of those price differences amount to a large share of that overall 20% decline that I showed you before. And then second, as a number of the other papers have done, we're going to trace the recovery in prices that I showed you before back to specific Fed announcements, and which key announcements sort of boosted prices and which ones didn't is also going to be really informative, we think, about the types of explanations that one needs. So I'll get back to the explanations after showing you the data, but let me just jump to the conclusions there. The first thing is this is going to be a challenge to a frictionless explanation based on either just cash flows or risk compensations. I'll be clear about that. We're also going to depart a little bit, or some of this tension has been arising in some of the questions. I think Vish asked something, Ricardo asked something. This came up in the Zhiguo and Darrell papers as well, about a more dealer-centric view of kind of short-term liquidity provision and short-term constraints. We're going to show you some evidence that we think challenges that view, and we're going to argue that the most consistent explanation for these patterns is more sustained, longer-term selling pressure rather than constraints on short-term intermediation of investors trying to obtain cash. Okay, there's still going to be a lot of questions unanswered, but we're going to try to make some progress here. Okay, let me start with an example. So this is a bond issued by Google that has about 6 years to maturity at this point in time. And what I'm showing you here again, so this is basically the period of March where bond prices decline, obviously meaning yields are going up. I'm showing you the bond price or the bond spreads in these blue dots, along with the CDS spread for Google in the orange. Okay. Now, at this point in time, Google is AA rated. They have cash that well exceeds all of their total liabilities by about $100 billion at this point. It's a very safe company. It's hard to imagine much risk of default. The CDS spread is reflecting that as well. It's around 30 or 40 basis points. Yet the bond spread, so over a duration matched treasury, is spiking to about 150 basis points. Okay. There is trade happening at these prices. Each one of those blue dots represents a trade from the trace data. So what this is saying is that even for really safe companies that are financially sound, their bonds are trading at prices well below what you would expect here, about 90 cents on the dollar for Google, based on their financial position or what the CDS market would imply. Okay, so that difference that I showed you there for Google is much more pervasive in the investment grade bond market. So here now I'm plotting the bond spread and the CDS spread averaged across all the investment grade companies that we have, again, matched as the same companies, and trying to pick a maturity of around 5 years to match the CDS spread. And you see something similar here, right? The bond spread is spiking up dramatically in the middle of March, and the CDS spread is rising only modestly, meaning the basis, which is this black line, is opening up dramatically for investment grade, okay? That's more unique to investment grade. If you look at high yield, the bond spread and CDS spread track each other more closely. And this is a really big effect. In another way to put it is, if the bond spreads had behaved like the CDS spreads did, so you could construct a synthetic corporate bond by combining a treasury and selling protection in the CDS market, that would have dropped by about 5% in total value versus 20% that we saw for the for the actual bond. So those dislocations are a huge part of the overall price decline. Now I'm kind of unpacking that in the cross section. So looking at individually matched CDS and bond spreads for all the different companies that we have. And what I'm plotting on the x-axis is the change in the CDS from basically the start of March through that 3-week period to March 20th. And then on the y-axis, I'm plotting the change in the bond spread. Okay, and there's the 45-degree line. You can see for high yield, which I have in red there, those tracking each other pretty closely, moving kind of one for one as you would kind of expect. And you can see for investment grade, this big cloud over here of companies like Google, where the CDS spread isn't changing by all that much, but the bond spread is opening up substantially. Okay, so again, this is saying that these are highly concentrated in investment grade and even in the safer end of investment grade. Now, the other dislocation here that I want to show you is the ETF NAV basis. So ETFs have grown a lot over the last 10 years, totaling around $1 trillion at this point. They're usually perceived as much more liquid than the bonds that they invest in. And here what I'm showing you is the difference between the price at which the ETF trades and the price of the underlying bonds as reflected in the NAV, okay? And you can see that the ETFs for investment grade, so that's in the blue line here, trade at a substantial discount to the value of the underlying bonds. And again, these are not small numbers. It's about 5% difference here, okay? And you don't see the same thing for high yield shown in the red, okay? All right, now, this is just to quickly show you, these disruptions seem to be synchronized. So here I have the overall drop in prices for investment grade, as well as those dislocations that I showed you. They're all kind of matching each other in terms of timing. And what really seems to reverse them, and when prices really start to recover, I have these dashed lines, which are the two interventions by the Fed that we're going to focus on, the March 23rd and the April 9th. So let me talk about those now. So we're going to look at those two announcements, March 23rd and April 9th. And in order to do that, a lot of the other papers have been talking about how there were a lot of announcements coming out. It's hard to really disentangle different effects. We're going to zoom in using the ETF data where we have prices at basically 5-minute intervals. We can zoom in exactly on this particular announcement to avoid any other confounding effects there. And what we see is, here's the announcement on March 23rd. We see investment grade bond prices jumping by about 6% on the announcement. Okay, so a big effect due to the announcement. And we basically see no reaction elsewhere. So it's a very segmented effect. So we don't see anything for long-term treasuries, for stocks, or for high yield. The size of this response is pretty large, given the size of the facility was $300 billion. We're taking the 6% return and multiplying it by the total size outstanding for investment grade. And that comes to about a $360 billion increase in value, okay? So let me turn now to April 9th. And April 9th, remember, was expanding the scale and the scope of the purchases. So also increasing to fallen angels, going more toward the risky end of the spectrum. And here, again, we're zooming in right on the announcement. We're seeing a big jump both for high yield and for investment grade, as well as a little bit for stocks as well. So this has been interpreted as sort of the whatever it takes moment. So taking those two together, we're concluding that the Fed contributed a lot to the recovery in bond prices. But what we think is probably the most interesting here is which interventions sort of boosted prices and which ones that didn't. So the two things to take away are that the announcements to purchase bonds in the future, remember, these announcements, they didn't actually purchase anything for sort of months after, and even then, relatively modest amounts, had big increases in bond prices, while other policies aimed at extending credit or relaxing dealer balance sheets in other ways didn't seem to have big effects. So I'm not showing you all the other announcements that were made, the primary dealer credit facility, the relaxing of the supplementary leverage ratio, because those things basically didn't have much of an effect on bond prices. And that's going to be informative for our story. Okay, just to show you this a little bit more granularly, I have individual bonds within the rating categories. So these are changes in log spreads. This is for March 23rd and for April 9th over on the right. And you can see again this segmented effect showing up on March 23rd, where right when you hit the investment grade high yield cutoff, there's a decline in spread for investment grade, but not so much for high yield, a little bit more concentrated on the safest end of investment grade, whereas April 9th has kind of this more widespread effect across those. Now in the paper, there's a lot more that we do. We do maturity, important for the bonds that are being eligible or not for the facilities, whether they belong to an ETF, interesting because the Fed purchased ETFs directly as well. I won't show you any of that evidence. Now, part of what's going on in these announcements is just in terms of closing these dislocations that I showed you before. So here, I'll just mention this result pretty quickly. The March 23rd announcement in particular seems to be about closing the CDS bond basis, or a lot of it seems to be about closing the CDS bond basis. So the bonds for which the spread declined the most on March 23rd were those for which the basis, but not necessarily the CDS, had risen the most in the period prior to that, okay? April 9th, again, seems to be less about just the dislocations and more of a widespread effect. Okay, now let me spend some time about interpreting the data and saying, what can these results tell us about what might have caused the prices to decline in the first place? Just briefly to talk about fundamentals, this is kind of a natural explanation given that there's a big economic shock going on. They have a hard time explaining what we find though. Difficult to explain similar losses for investment grade and high yield. Also just difficult to line up with the dislocations representing the bulk of the price declines. So I won't spend too much time on that. Another possibility, a sort of naive interpretation, is that there was just a complete market freeze. Markets completely broke down and trading couldn't happen. That doesn't appear to be true. There definitely is substantial volume throughout this period. But as some of the other papers have pointed out, maybe it's a little bit more nuanced than that. Maybe it's that there are trouble with dealers at this particular point in time that are contributing to the price decline, okay? So that view is that the plumbing of the financial sector had difficulty processing all the trade that wanted to happen at this particular time period. This story is appealing for a number of reasons. Banks are definitely better capitalized than they were in 2008, but they also face a lot more stringent regulation, and the cost of balance sheet space is larger. Now, consistent with that evidence, we can see that participation in corporate bond markets has declined a lot for dealers in the recent period compared to where it was, say, in 2008. So I have the fraction of the total bonds that they're holding is about an order of magnitude less than it was, okay? So there is this disintermediation due to post-crisis regulation.
Can I ask a clarifying question? Are these primary dealers that you're mentioning only?
Yes.
Okay.
Yep. And we also see, I think Mahyar showed a graph very much similar to this as well. Dealer holdings actually declining as prices are falling through this episode and only increasing sort of later on, okay? Now, I'm going to argue our evidence poses a few challenges to that purely dealer-centric view of things. The first one, and we think this is really important, is we see these really strong price and quantity responses only when the Fed announces future bond purchases. So again, when they make these announcements on March 23rd, they don't actually buy any bonds for months later, yet prices are responding a lot immediately. We've talked about it's hard to evaluate, in some of the other papers have mentioned things like the primary dealer credit facility, because a lot of these announcements are sort of close together. We can zoom in by looking at the prices, and we find basically no price response at all to the primary dealer credit facility and no price response to the relaxation of things like the SLR on April 1st. Okay, so the lack of evidence there suggests that policies that were aimed at more directly at dealers didn't have such a big effect. And then finally, intermediation costs we would sort of think would be larger or equal for high yield, and I think some of the other papers were looking at this, than for investment grade, yet we really see the dislocations concentrated in investment grade. Okay. So then what do we think is going on? We're going to argue that the explanation here doesn't seem to be purely about dealers. So our view is that this tells us that these low prices are reflecting a more widespread and probably a more persistent selling pressure during the period, okay? Let me outline that a little bit more. So those price dislocations are really suggesting a need for liquidity or cash. So one possibility is selling more liquid or investment grade bonds. I'll point you to this paper by Yao Zhang and co-authors that's making that argument. Selling bonds rather than insuring them with CDS, selling the bonds raises cash, and then selling more liquid ETFs first, generating more price pressure there, okay? So we have a little bit of data on quantities. We would like to have more, and we want to try to go there more. But this question of sort of who is selling, we have data here for mutual funds. Itai Goldstein and co-authors have a paper on this as well, showing that the outflows for investment grade corporate bond mutual funds were really substantial, unlike anything that we've seen. So $100 billion outflow in this period, matching up with this price response. Other thing to mention is that future selling here can also play a big role. So immediate selling might just be the tip of the iceberg, but worries or fears about future selling, either from mutual funds or for other agents, can create large price drops. So I've talked about that for mutual funds. That also brings into this picture potentially insurance companies. They typically tend to be slower moving, so maybe they're not the ones selling in this immediate panic, but there could be fears about predictable future sales, possibly from regulatory constraints or other things that they face coming down the line that could be depressing prices today. And then finally, issuers, you know, borrowing more due to this extreme revenue shock from COVID-19, so a future effect in supply. Now, I also just want to highlight that the anticipation of future selling can work. We see this in the anticipation of future buying, boosting prices now. So the Fed effect is really large there, even though buying hasn't started and didn't happen for a very long time. Okay, so let me conclude there. I think I'm just out of time. The COVID crisis created really large dislocations in debt markets. Investment grade bonds fell by about 20%. About 3/4 of that is associated with a price dislocation, as viewed from the CDS bond basis or these ETF NAV dislocations I talked about. The reversion in those seems to really be focused on these Fed announcement dates, and in particular, the announcement to buy bonds farther out into the future, but not other interventions extending credit or relaxing other regulations. Overall, we think that this strongly suggests more widespread and persistent explanation for what's going on, so persistent selling pressure, rather than a frictionless view or kind of a purely dealer-centric view, and so consistent with a lot of institutions needing liquidity. I didn't cite all the papers I wanted to cite. I want to say we acknowledge that there's lots of great work going on, some of that which, a lot of which we've seen here today, and we've learned a lot from all of these papers, so thank you.
Thank you so much, Tyler. So let's open up for questions. If you're in the audience, please use the raise hand feature or the Q&A feature. And well, let's have questions.
Can I ask a question? Oh, okay.
Can I ask a question?
Sure, go ahead.
Sure. So about the price dislocations, both the ETF to NAV as well as the CDS to the bond basis are based on quotes data rather than actual trades. So the figure, I'm assuming, unless correct me if I'm wrong, it's a different source, but for example, the CDS bond basis that you showed, the bond prices are coming from trades, which are trades, whereas the CDS prices, I would assume that they're coming from market. So it doesn't really tell us that if we were to look at trades in the CDS market, we would find the same basis. And it's not that I'm arguing about the dislocation because it's clearly there. It's more about there was probably dislocation in all of these markets to a different extent, depend on the intermediation and the dealers participating in those markets.
I'll take this one. So you're correct that it's like, you know, the data we have is actually from Capital IQ, and I think it's from IC originally, but it's quotes. That said, as you also pointed out, those differences are big. So one thing we looked at is at the CDX indices.
So for those, we can't really match to the bonds, but like these are very liquid and these are based on the most liquid CDS names, and the distortions are just way too big. It's like, I think if we're trying to argue about basis points, there would be a case to be made about our measurements not being the best, and I think we're not trying to defend that. But now we're talking about like 3-4%. Now we're talking about very, very large difference, and even the distinction in those differences, for example, between high yield and investment grade are just so big in a way that our take is that they would survive any of those measurement things. And as I try to explain, we try to take many different stabs at measuring this. So, there are different
all I'm saying that you should compare apples to apples. And even if you go back to the data in 2008 and you look at CDS trades versus quote prices, the deviation were of the same extent that you are talking about. So you would see quotes still in the 120 basis points for firms that were traded up in the 500 basis points. So it's...
You wouldn't see that in the CDX, like the CDX.
Oh, it's more than it's measured. What, sorry?
The CDX are not based on quotes, they're based on trade, like people trade this index.
From market, it's based on quotes of, the CDX is traded as on its own, it's not based on the underlying traded prices. So it's also quoted. So.
It's traded. I understand that it's not a trade of CDS contracts, but it's traded, like people, it's a meaningful price.
Yeah, the CDX is traded security. Yes, I'm aware of that. And its spread is determined by itself, regardless of the underlying constituents. So all I'm saying that the market prices even for the CDX basis is of quotes of underlying contracts and quotes for the index, which might be different as historical data as shown, especially in stress times, that the quotes in market are very different than the traded prices.
Okay.
So I wanted to point out that perhaps the plumbing and the persistent demand for transaction are not mutually exclusive explanation. It looks like they work to reinforce each other. So if there's a large persistent increase in the demand for transaction services with plumbing problems in the dealer sector, you'd expect a persistent rise in transaction costs, which we saw, it seems, and that lower price because transaction costs increase, and also, if there's more demand for transaction, you imagine the present value of future transaction costs that investors expect to incur also goes up mechanically because they expect to incur them more often. It's unclear quantitatively that story works, and there might be interesting back of the envelope calculation to make there. But it looked like they are linked to one another.
And I would actually second that. I think both could be going on. So the paper on agency MBS that I have with Zhaogang, so there too, like we look at the dislocation, which was a basis between the spot contract and the futures contract, and this basis also widened, just like your CDS basis, and a lot of that because of huge amounts of selling, customer selling. Then on the dealer side, they were accommodating the liquidity to some extent, but it's just the quantity of selling was just too much. So it was a combination of the two. There was sort of cash constraint on the customer side, and there was a balance sheet constraint in a relative sense on the dealer side.
And we definitely are on board that these constraints matter. They're important. The question I think is like how much of these really big price movements that can account for. I completely agree with Pierre that maybe we should do like some formal accounting of this. It seems to me that it would be very hard for the poor transaction cost view explain a lot of this variation. And I think the fact that the PDCF didn't work and the leverage ratio didn't work as well tells us something about these stories, right? But maybe, of course, that's our take. That in terms of like can it then really explain, the bulk of these price movements, and
I have a clarifying question related to that. Sorry, okay.
Like, can I just add one small thing? Is that there's a little bit of like something a little bit contrived in the way people wrote models and wrote theories. And I think when people think about this is that, of course, if we had a perfectly risk neutral dealer that can absorb any quantity of stocks, we would see no movement in prices whatsoever. We would have a risk neutral agent in our economy, no problem whatsoever. Prices would be always at fundamentals. We wouldn't even have risk premium. But that's not a very constructive view of the world, and I think meaningful view of the world. Like, I don't think anybody, when we think about the design of the financial system, think about creating this like risk neutrality and no frictions whatsoever, and any flow of selling can be absorbed. Our point is more that there was a big macro level selling force in this economy that pushed prices away. In part, dealers were not able to absorb that. We think that there's no like amount of dealers you could do in a way, or the precise number is hard to tell, but like fixing the details of the balance sheet constraints would likely not change that. And this is not a view just based on like abstraction. It's a view based a little bit on evidence. That is like when we saw that we try to like do realistic intervention for the dealer of like changing their constraints and so on. This didn't fix the prices immediately. Like it seemed to be a lot this announcement of future buying that really moved the prices and had a big effect. So nobody's that. I think we're never arguing that dealers were not in trouble during that period. We're just saying that the view that it was that relieving dealers would solve everything is a little bit is not super plausible based on the data. And again, the only way I think we could revive it in theory in the view to say like, well, of course, if the dealers are willing to buy anything that comes to them, then there would be no problem. But that's a little bit contrived. I think that's not the right debate to have.
Can I ask a clarifying question on your results that I may have missed? So when you're saying that the bond prices reacted more strongly for around the purchase announcement as opposed to kind of intervention that relaxed, the dealers' leverage constraints, is that true more for corporate bonds than for treasuries? Because I thought like Darrell's and Zhigo's story was more for treasuries, right? And so, or are you saying that the selling pressure is also strong for treasuries?
No, so you're entirely correct. So it's like in the early stage of the crisis, it looked a lot like treasuries and corporate bonds were living through the same thing. And actually those interventions draw a very different picture. I think, actually I wasn't there this morning, but I know Darrell's work or Zhiguo and Stefan and then Zhaogang's work. This is very convincing. I think that in the world of treasuries, dealers played a huge role, and interventions to dealer actually had a very, very big impact. For corporate bonds, it seems like the story is different. Like, I wish there would be a huge unifying story, but the data really shouts for two very different stories. And so in corporate bonds, we see virtually no impact of like the dealer announcements, and we see very, very large impact on these bond purchases. And that's actually also what Nina showed just before us as well.
Can I ask a question? Do you know to what extent the investment grade bonds are backed by service firms?
We could know. Right now we don't know, I would say.
So the reason I'm asking is that I hear from Paco that apparently in this crisis, services have dropped down, and they're typically very resilient in a recession. So this is kind of special for the current crisis, that actually also services have been deeply affected. So I was wondering to what extent that could justify the drop in prices for investment grade.
I see. No, so that's a very good idea. Actually, just yesterday we were talking about we're revising the paper now, and we're trying to think, more generally, do the deviations line up or not with sectors that are more in trouble, sectors that suffer more because of the crisis directly or not, and I don't know the answer yet. But I think that's a very, very good suggestion.
We look at that in our paper, so you can see that analysis where we split it up into differentially affected sectors. We take that approach rather than a sort of services versus non-services split. So you can read about that there.
And you do see into the CDS prices do move for the usual suspects. If you look at cruise ships, right? You see this high yield spreads moving a lot, and the bases not moving much. So
I imagine airlines.
Yeah. So
until they are bailed out, at least.
Yeah. So CDS data is informative, right, about this these fundamentals, right?
So one question I was kind of curious. You know, I think we had a very interesting result where we're showing the second announcement, which was in April, and that had like a more broader effect, right? But when you're looking at different asset markets, it only had a broad market effect on corporate bonds, but didn't seem to have an effect on other asset markets. Why do you think that is? I would have kind of expected it would have like a general effect, right?
I think there are different announcements on the date. So the announcement on Sunday that included the corporate credit facilities and included a number of different Federal Reserve announcements all being offered up together. Whereas on the 9th, that clarification was, I think, not accompanied by as many different announcements. I think it's a challenge in thinking about how to interpret these questions and how to kind of clearly identify any particular thing when a number of different interventions are being introduced at the same time.
But I mean, but at the high frequency identification, I think I'm with you, that is hard. But when you look at the data, you see that, you know, like the high frequency identification tells you that there's a lot of action on the corporate bond space in indirectly targeted markets, right? I think what you were saying would tell us that it would be harder for us to identify this cleanly, right? I think the only possibility is that March 20, you know, in the weekend, we all were living through that weekend, right? And that was a very, very scary weekend before the Fed intervened. There was a lot of bad news. VIX shoot up. So one possibility is that there's like a lot of bad news, and then the intervention did have a broad effect, but we can't measure in the stock market because, you know, it would have been worse if the Fed didn't intervene. But the high frequency data disproves that, in the sense that you can look at like the, you know, within the 5 minutes of the announcement, the futures market is open, and you don't see, you see some initial boost, and then the market comes down again. So I think that's all in the paper, it's not in the presentation, but yeah.
But Alan, the set of bonds that you can actually do the 5-minute announcement on is very special. Like, that's not really a representative universe of.
I'm talking about futures markets. What are you talking? I'm talking about the future market for the S&P 500. That was my statement. And the other statement was about CDX transactions, you know, high frequency data on CDS, bid-ask quotes. I mean, they don't revert the CDX data, and the, you know, the S&P futures market is very liquid. So I don't see the issue there. But I'm happy to, you know, talk more about that for sure. But I feel like,
just one thing to add, I think that's a little bit more broad even than this specific point is, in all those identification strategies that we're all using, there's a little bit, like, we lean a lot on some idea that there's some segmentation between those assets. You know, when the Fed announced they're going to buy only bonds under maturity 5 years, you know, presumably a 4.5-year bond and a 5.5-year bond are close substitute for final investors. And so we could imagine that those interventions have a big effect, even if we didn't see a differential response. So those differential response, they're both characterizing the effect of the policy and the notion of segmentation. But I think as economists, we don't, I mean, as anybody actually, we don't understand very well where this segmentation is, why it's not. And I think that makes, you know, some of the challenge that Anna pointed out, or what you pointed out, Asani, I think are going to always be there in a way. It's like when you see sharp evidence along segmentation, that's nice. That's like good identification. When you don't see it, it's not telling you that the effect is not there. It could just be telling you that there's not as much segmentation as we thought. And it's going to be really, it's just really harder. And these are difficult challenges. So in some ways, you know,
thank you so much, Valentin. And if I'm sorry to interrupt, but well, time has run out. So I would like to thank everybody who attended. I would like to thank especially everybody who presented, and especially our co-organizers of this workshop. So on behalf of Search and Matching Macro and Finance, thank you so much. We will stop the recording now. However, you guys, everybody is invited to join us on Gather. Just click on the link, and I am told you will be right there, and then we can keep chatting informally. But before we end the recording, I'll invite Ben Lester, one of the co-organizers, to make the closing statement.
I can unmute myself. Okay, yeah, just on behalf of Pierre-Olivier, Mahyar, and myself, and the organizers of the Search and Matching, we just want to thank everybody for attending today. As Pierre-Olivier mentioned at the outset, we just sort of witnessed an incredible shock, along with somewhat unprecedented interventions that followed. One thing I think is really interesting about a global pandemic is that this is about as exogenous a shock as I can think of. And in particular, it's a shock that did not originate in the banking sector, unlike what we saw in 2008. So this offers a really unique opportunity to study the kind of issues that many people on the Zoom are interested in. And it's just been a great opportunity to see the very kind of initial research coming out of this episode, to share our own research with this group, and just to be a part of the discussion that will formulate some of the outstanding questions, the next steps, so on and so forth. So thank you all. I hope the discussion will continue through other channels, and I look forward to seeing many of you, hopefully in person at some point in the not too distant future. So it was nice to see everyone's faces, even in little tiles on the screen. Take care, everybody.
Thanks, Ben. See you.